All right. Yo, what's up for everyone watching this on the YouTube replay? I hope you're having a good day. The market's doing oh, well, ignore that. Robinhood's trying to get me to sign up for DoorDash and I'm not accepting it. But anyway, check this out. Here's our Robinhood portfolio. I'm going to start with a quick stock portfolio update. Then I'm going to deep dive into all of the stocks. All the stocks that you guys have in the chat for me to analyze. So yeah, here's my dividend only portfolio. Year to date, we're down 0.3%. Over the past year, we are up 15.6%. And if we compare that to the S&P 500, excuse me, I just got back on a run and I'm kind of tired now and my mouth is dry. But anyway, look at this. We are up 25% the past year, or the S&P 500 is up 25% the past year. We are only up 15%. So we have underperformed the index, the main S&P 500 index a little bit in this portfolio, but that's okay because our other portfolios have kept up the slack. But here are all our holdings in here. As you know, this is called my dividend only portfolio and every stock in here does pay a dividend. I got Google, McDonald's, United Rentals, Carlisle, Constellation Energy, and Meta stock. Our largest holdings at the top and our smallest ones are at the bottom. And here's our total percent change on every stock. So the only company we are technically total return down on is CSL. And I've owned this stock for over 2 years. Technically, if you include the dividends I've received, I'm actually total return up on them after you include all the dividends I've received from them. Oh, wait, heck, check this out. We're actually about to get another $14.52 in dividends from this company. So not too shabby. I'm excited for that. And yeah, that's what's cool about dividends. You basically get paid every quarter just for holding these companies. It just adds to your buying power. You can withdraw it or you can reinvest it in the company. And that's what I always recommend. Reinvest the dividends, build that snowball effect in your portfolio. We also have our Roth IRA. A Roth IRA is a tax-free retirement account. Now, I can't withdraw the money till I'm 55, but I can actually withdraw it as a first-time house buyer. So if you're a first-time house buyer, you can use part of your Roth IRA as a down payment, which is pretty cool. So here's my Roth IRA. Here are all the companies we own in here. CVCO, Cavco, they report today. It's a home builder. The home builders with real estate interest rates really high, they've been struggling. And hey, what's good, Looney? Yeah, we'll actually check out Nvidia after this. And hey, Looney, thank you personally for showing up to that Nvidia stream. I really appreciate it, man. I was really nervous. I didn't know if I wanted to do it, but I built up the courage and I did that, Looney. But I appreciate you. So yeah, here are all the stocks in our Roth IRA. Our by total percent change, Innodata has been our massive winner. Literally just in 1 month, they're up 101%. I did not expect that. I've held Cavco for a bit. It's not doing well. Yeah. So it's not just a Cavco problem, which is unfortunate because what they do is they build homes. Let's go check out all the home builders. What's the most popular one? Isn't Lennar's a huge one? Let's see how Lennar's doing. That's ticker symbol LEN. Okay. Can we please load here? Okay, there's Lennar. Yeah, look at Lennar stock. So it's not like it's a whole real estate wide sector because bonds are really low. So Lennar struggling, DR Horton, so Cavco's no exception, but they are the most well positioned. You know why? This is a completely debt-free company. They have no debt whatsoever. They have like a $200 million backlog. They're my favorite home builder if I had to pick one, and they build HUD homes. Factory built homes. What's up, I Air Ronnie says, what's the most attractive nuclear energy stock? I'm thinking about picking up CEG. That is absolutely my favorite nuclear stock, and it's still on a pretty good deal. Year to date, they're down 20%. This is the largest and purest play for nuclear energy. They own over 30% of all the U.S.'s active nuclear reactors. They already own the assets. I'd stay away from like those SMR companies, those small modular reactors, like NuScale. I'd stay away from Oklos especially, but CEG is my favorite one. So they already own the most nuclear plants. They're fairly valued even today at a 23 forward PE, meaning they trade at 23 times net income and a 0.5% dividend. So full disclosure, I do own this one, but I own them for a reason. I've analyzed every utility stock out there that exists pretty much. Out of all the utility stocks that exist, this is, in my opinion, going to be the growthiest one and the one you really want to own long term. It's the most high quality. They do dividends, share buybacks, M&A. They just acquired Calpine. The Calpine acquisition is instantly accretive. $2 of yearly EPS to them. I kid you the heck not. You heard that correctly. So $2 accretive to the EPS from this Calpine acquisition. They just had record net income. Look, the acquisition just went into effect. So record revenue up 63% year over year. That's what you want to see. Revenues up 63, and not just revenue, record net income. After-tax net income was 1.6, including a small little acquisition fee. It was slightly higher because the before tax number was a 2.27. So that was real after-tax net income, including a slight adjustment, 1.6 billion. So I'm really bullish on the future amount of this company. So PJM Interconnect accelerates data center capacity, and guess what? Constellation Energy is they're restarting the 3 Mile Island nuclear plant and putting it into the PJM auction, which is this like 5 states, or maybe it's like 7 states, all electricity auction, all the prices. So. All right, I got to continue with the portfolio update. I apologize. Then we're going to deep dive into all of your stocks. I appreciate everyone that's here. What's up, everyone? If you're liking this, please leave a like. I'm fully transparent with my portfolios. I sell absolutely nothing. Just trying to share what I think is the right thing to do with investing when none of this is financial advice. So here's my other portfolio, fully transparent. Look at this. We're only up 20% all time. So it's not like we're outperforming the S&P, but yeah, we do have some big losers in here. I'll share with you my winners and my losers. I'm down bad on like UiPath, Sprouts Farmers, Zoom, Futu. This is one of the best buys right now. I'm not kidding if you're into fintech. All fintech is struggling right now. I do own SoFi. I'm still up a good chunk on SoFi, but all these fintech companies, I really think SoFi is a good deal right now. Robinhood's decent, but AMD has been my main winner. I can't believe there's chips right now. GPUs are here. Actually, specifically AMD is right now there's a memory shortage, and also right now there's a CPU shortage, and AMD and Intel are raising prices like crazy. That's why we've seen Intel and AMD go nuts on partially from CPU, but also just momentum, but raising guidance and stuff. So I'm super happy with AMD. I certainly wouldn't buy shares here today, though. I got like Reddit, Iron Mountain, Microsoft. Actually, here are all my most recent purchases in their exact order. So I just bought Ouster. I can't believe this. I don't know. I bought this company literally a month ago. I bought all my shares on that day, and literally just in 1 month, we're already somehow up. Wait, there we go. We're already somehow up 92%, or I can't believe it. We just bought Uber for the first time ever as well that same day. There's my buy order. I bought Uber, and also, it's not going to let me scroll over. Okay. Well, I bought Microsoft as well that same day. Microsoft is it's actually the number 1 software company, the number 2 cloud company, and one of the best AI plays. As a huge owner of ChatGPT, but they are kind of lagging behind the Google Cloud and AWS in terms of growth, because with Google Cloud, they have their own chips. Amazon, they have their AWS Titanium chips. And Amazon doesn't have, Microsoft doesn't have their own chip like that. I've been super impressed with Google. Google's not just YouTube anymore and search advertising revenue. They're a huge cloud and AI play. Google Gemini's taken off, and that's why the whole thesis has changed in just a year. That's why we've seen this massive rally in just 1 year. And it's not just momentum, their fundamentals have really improved. So lastly, I have a Moomoo portfolio. This is actually called in the top left, my buy and never sell portfolio. All time, we are up $31,000. Return money weighted, I can't believe it. And just year to date, we are up $18,000 or 62%. And we just keep it boring. I literally just own 6 companies. I don't do options or crypto. I do the most boring thing, but sometimes doing this really boring thing can give you the highest returns. I got Comfort Systems and Powell Industries. These have really led to the gains. Like literally this is from 1 year ago. Just a year, the stock's up 400%. Powell Industries is up 900% since I bought it 2 years ago. So that's what's led to our crazy returns, just mainly those 2 companies. I'm up. And then the other ones are only up like 1,400. But I'm super excited the future of Amazon. I've been loading the boat. They're on my buy orders on them. Why Ouster? It's a lidar play, and it's also good question. It's not one I trust with a meaningful amount of money. I usually don't like buying money-losing companies. If we go to Ouster, they lose money, and but what I do like is that the losses are narrowing, and the revenue growth is explosive. Just organic revenue, like they didn't acquire a company to get this. This is organic revenue growth. Revenue's up 48%. And they've narrowed their losses by 20%, even made a net income last quarter. They actually received a $21 million royalty payment for someone using their license. And that's what kind of artificially sent their net income positive. But they're really narrowing their losses as the revenue's growing organically. It's a huge lidar play. And what's being used in lidar right now? Autonomous vehicles like Waymo, as if anyone's heard of those. And Zoox is. They're all over Vegas. So anyway, Ouster's pretty cool. You like Uber. Uber's getting into the autonomous vehicles, and I think this is the picks and shovels play. The platform you go to book a Waymo or a robo taxi, that's where some money's going to be made. And Uber just they don't have to own the robo taxis. They just collect a high margin fee every time you book one, and they have an incredible network. It's my second most recent purchase. Hey, what's up, Remco and Rolando? Good morning. Hope everyone's having a great day. So, someone said Marriott International, the hotel company. This is a pretty cool one. Hilton and Marriott have done phenomenal because they're actually a bit of a royalty type companies where they collect franchise, basically royalties from everyone that uses their name. They have a nice 0.7% dividend that they raise every year. Let's see the net income. Yeah, look at this. Super strong. I mean, easily like like 700 million of after-tax net income a quarter if we kind of average it out. And what are they doing with 700 million of net income a quarter? Really, there's their dividend. Their dividend only cost 178 million, so massive room for them to raise the dividend, but mainly share buybacks. I know no one really likes to deep dive into the numbers, but I just like to show this that they spend 700 to $1 billion a quarter solely buying back their own shares. What's the benefit of that? Here it is right here. This is so cool to me. The net income fell 2.5% year over year, but the net income per share actually grew by 1.67. So how did the net income per share grow when the net income fell? It's the share part of the ratio. Since they bought back so many of their own shares, the EPS grows a lot more. So even when the net income is negative, their EPS growth was positive. So the share buybacks really help out shareholder returns. Pretty cool. Hey, what's up? Ahmed, he says, Astera Labs, I just bought 40 shares. Or I bought at 40 a share. I was going to say, yeah, I wouldn't buy the stock at all-time highs, but congratulations if you bought this one at 40 a share, man. So we were just doing analysis on this one. This does like data center communications, where if you have a data center running on AWS and you need to send data to another data center, maybe on Microsoft Azure or something, these are the antenna companies that do that. They're pretty cool. It's the AI infrastructure level, and this is why they deserve to be at all-time highs. They're not just at all-time highs because they're AI and momentum. They're at all-time highs because the fundamentals have really improved, and this is what justifies the stock rally, in my opinion. Check out the revenue growth year over year. These are the year-over-year growth rates in green at the bottom. It grew 93% year over year. After grew 144%. After grew 290. Like if we just zoom out, the revenue hits a new record every quarter. Like in 2023, they were literally doing 10, 17 mil a quarter. Now it's 308 million just this quarter. And at this growth rate, what's it going to be the same time next year? And I bet you're wondering, so this is revenue. What about actual profits and net income? Check this out right here. They're the most profitable they've ever been. The net income grew 152% year over year, even faster than the 93% revenue growth. What does that mean? That means net margin expansion. Their net margin actually grew 30% year over year. And last thing, a fortress balance sheet. This is another thing. They have absolutely no debt. You go to the cash, they have 1.18 billion of cash. Long-term debt says zero. So they actually have so much cash that they're earning interest on it. They made 11.58 million of just interest. They're making 11 million of interest on their cash every quarter. It's phenomenal. Unfortunately, they are very pricey at 120 forward PE, but with the fundamentals like that, I can see why they're at all-time highs. What app are you on, or what application do you recommend? Yeah, hey, this one I'm on right now is my absolute favorite brokerage to buy and analyze stocks on. It's free, costs nothing. And actually, I have an affiliate link if you'd like to check it out. I have a LinkedIn profile or LinkedIn bio there, description, and it's called Moomoo, though. You can just type it into Google, broker called Moomoo. But yeah, it's my favorite app. It's free. I actually like it more than Webull and Robinhood. I have all these other brokerages as well. I have them linked in the description too. But yeah, Moomoo is my absolute favorite. All right. Let's see here. Yeah, LinkedIn profile there. Let's see. CEG is a great stock. Yeah, that really was. What's up, Louise? Good to see you. Shout out to member Louise. So SPCX, is that space? Oh, that's not space. Exploration Technologies. This is an IPO that's about to happen. So I wish I could give you thoughts on this company, but they haven't IPO'd yet. So I'm trying to look at their financials here. There's nothing I can analyze. So that's a recent IPO that maybe you could pay attention to. But recently, what we've seen, a lot of IPOs initially rally up like crazy, then fall. Um, and I don't think if you buy before the IPO, you can't sell for 30 days. And usually within the first 2 days, they rally up like crazy. I'd stay away. What's that new company? It was called like Credo. Nah, what's that new company that IPO'd? It was like Credos. So, oh, I'm fumbling this. Someone will know in the chat because it's really popular. It's like an Nvidia type stock. It's like CoreWeave or no, it's something Cerebrus. There we go. Okay. Cerebrus, this thing just IPO'd. How'd this do? So yeah, here's what normally happens. The sucker rallies instantly crazy and then it kind of fizzles out. Because the momentum's usually on the first day. But anyway, I'd be careful with IPOs because usually it's always at a price that's, usually overvalued. So, all right, let's look at some more stocks here. Yeah, thanks for that, Simply. Yeah, Cerebus. Why don't you have VOO or VTI? Yeah, I'm basically my own ETF personally. So what I try to do personally is, and I first off always recommend owning the S&P 500 as the backbone of your portfolio. The average retail investor and hedge fund and institution literally does not outperform the tech-heavy S&P 500. Oh, I have actually a funny meme I could show you. This is actually real funny. So the top. Oh, that's actually going to make sound like the type of analysis hedge funds be doing just to underperform the S&P 500 every year. This is crazy. Like, I recommend always to own the S&P 500, but I'm a stock picker and I try to personally outperform the index. And so far, we've done that successfully in this account right here. Well, when we combine all our portfolios, we have. But yeah, try and just keep it very simple, like a Charlie Munger approach. Just own a lot of high quality, like simple. Look, I only own 6 stocks in this portfolio. I just really keep it basic, like another 6 stocks in here. My Roth IRA has 5 stocks. Like, I want to have concentrated portfolios of high conviction names. I don't want. Well, anyway, point being, I definitely own too many stocks. Okay. IBM just got a $2 billion in a government investment today. I'm actually shocked. I mean, the government just burned nearly $2 billion. You want to know how? The government just invested $200 million. I kid you not. This breaking news just happened. I don't know why, but the government put $200 million in D-Wave Quantum at a $9 billion valuation. They bought Rigatoni Computing at a $6 billion valuation, another couple $100 million. They bought a bunch of quantum stocks, new Quantum Act investment. The only good investment they did, which was the majority of the investment, was in IBM, which I totally agree is a great, real quantum play. The other ones are junk, not actual real quantum plays. I wonder if they put any money in IO and Q. That one's actually decent, but well, still bad when I own them. But I love IBM. If you're a fan of dividend growth stocks, they have a 2.8% dividend yield, and they traded a 23 forward PE. The reason they're, oh yeah, here's the news right here. Administration awarded $2 billion to 9 quantum computing companies, including IBM, $375 million. Taking equity stakes. Okay. So also included Inflection. I haven't heard of that one. D-Wave, Rigetti. IO and Q was excluded from the program. That's so funny. I literally just said, I wonder if IO and Q got added. They're still momentuming up though, but it's funny. They did not get an investment. That's interesting. All right. Enough with that. Let's keep going here. CEG a good buy right now. It's a little tougher of a buy than it was a week ago because Constellation Energy has had a great week. Like it's up like it was up 7% yesterday. It's up another 2% today. But even at right now's valuation, Constellation Energy is only at a 24 PE and 22 forward PE. They just reaffirmed $12 of EPS guidance for the full year, which is literally a 22 forward PE. I'm personally up 38%, so it's a decent nibble, but not the time to build a meaningful size position in CEG. You want it to go a little bit lower, but it is still at a price where it's maybe worth it to just do a slight nibble, but not go full in, if you get what I mean there. So yeah. All right. Sorry if I'm a little behind not getting to some of these stocks here. There's so many I got to get to. I appreciate everyone that's here. If y'all want to hit the follow button, I appreciate that. I try and stream every day, all the time. All right. So next up, I see. What's up? History says, how about NESTE? NESTE. I hope I can find that one for you. Is this the stock you're talking about right here? You'll have to let me know because I don't know. It looks like a Japanese or a European ADR. Doing oil products. So an oil company. I don't know if that's what you're talking about, but if it is, let me know and we'll check it out. The Finnish market. Oh, that probably was the company. Oh, but he said no. Okay. What would you buy now for long term? Good question there, Floss. So, it is still, basically all these companies, these are all my most recent purchases in their exact order. I still think Uber's at a good valuation. Microsoft's at a decent valuation. I still think there's so much upside on Microsoft. They're only at a 24 forward PE. That's one you eventually want to get in. AppLovin's a great software company. I'm so happy to be an AppLovin shareholder now. But yeah, Uber. Let's see what else is a decent buy right now. Oh, fintech, like financial tech companies are on a massive downtrend like SoFi. Check this out right here. SoFi, actually, let me give a super quick SoFi stock analysis, not financial advice here. It's a decent time to put a little bit of money in. Like if you wanted this as like 5% of your portfolio, don't go 5% today, but maybe make it 1%. if you believe in fintech. So here's my thesis. If they do a lot of loans. Recently, shareholders weren't happy because they basically issued $1 billion worth of stock, but then they loan out that money and it's really accretive to the EPS in the long run. If we go to their lending revenue, their largest segment of business grew 55% year over year. Look at that growth rate at the top. It's up 55%, after grew 25. So that's an incredible streak of growth. And not just that, their other half of the business, their financial services, arguably even more impressive. It's up 42, after grew 101, after grew 86, after grew 250, after grew 260. I can't believe it. So if you're going to own a company that does a little bit of share dilution and also doesn't pay a dividend, you want to make sure they're growing the business like crazy, and SoFi checks that box. Revenue hits a new record every quarter. Revenue's at 1.1 billion, and not just making revenue. We want to see a company making net income and profits. SoFi checks that box too. They're making a couple hundred million in net income a quarter. So they just had record last quarter, 173 million net income. Check out the future projections. Analysts project in 2 quarters, 237 million of after-tax net income. Your revenue is supposed to go to 1.2 billion. Notice always they slightly beat on revenue every quarter. So anyway, they're a very growthy, or just a great growth stock on a discount, and the valuation is fair. Here's actually the valuation, in my opinion, is undervalued when you do a forward multiple. So this is a growth company. You don't value them off trailing 12 months PE or EPS, which is net income plus the dilution. So check this out. They trade at 22 times next year's EPS, which is their net income plus the little dilution that they do. Only at 21 forward PE for the growth that they have in future projections. I'm real happy with them and nibbling on them. So that's my little thesis on them. So hey, someone said GILD. Hey Lisa, so GILD, this is that cool life science, or they sell a bunch of different prescriptions, I believe, and they have a nice dividend as well. So a 2.5% dividend. So it's kind of like a dividend growth stock. You buy them now, you get 2.5% of your money back just in a qualified dividend every year. So HIV product sales reached 5 billion. So that's maybe their main market, up 10% by that. I don't even know what this business does, but looks like they're selling that. Oncology sales grew 37%. Cell therapy declined 12% due to competition. I'm a huge fan of oncology. Johnson & Johnson's huge in oncology now. And they also have this third line. It says Verklury, whatever that is, their prescription sales declined 52% amid lower COVID hospitalizations. So there's kind of like a balance of one part's growing really fast, the other one's struggling. So it looks like for some reason net income projected next quarter is negative 8.6 billion, but even EBITDA is supposed to lose 6 billion, but I'm assuming that's a one-time adjustment because historically, if we just look at net income, they're always making like 2 or 3 billion a quarter. So maybe there's some litigation risk that's about to happen. I have no clue. Maybe that's something to look into. Yeah, incredible free cash flow and net income besides that. So yeah, there's all their different prescriptions. And Morningstar actually says they're fairly valued. Strong underlying growth in HIV portfolio and a promising pipeline of oncology launches are balancing by increased competitive pressures and impending U.S. policy pricing changes. So there is no forward PE because of that adjustment, but they traded at 17 trailing 12 months. So basically you do a 2-year out PE, probably at 18 forward PE, really. So, Case, what's up? He said run stock. This is one, unfortunately, I think this is a solar stock. I would be really careful with this solar stock specifically. Or let me get a refresh of their financials because I don't remember them. From what I remember, yeah, this is the tough part. Solar panels are it's a commodity. And so if we go to this company's net income, this is what makes this a tough buy. For all of history since their IPO, even around this, it was still a bad buy. Wow, they're losing a couple hundred million a quarter for eternity. So that's why I can't personally buy this stock. It's just too hard to trust. They might have revenue growth. Well, let's hope they have revenue growth. Let's see. Okay, yeah, wow, look at that. Looks like revenue. Man, I'm like swiping weird. I apologize. Revenue grew to 1.1 billion last quarter, but it's still no good when they're losing a couple hundred million. So they actually lose over a billion of net income a year. And the whole company is worth 3.5 billion. Now you can kind of understand why the stock has done so bad. They lose a third of their market cap a year in net income. So that's why 24% of all the shares are being shorted. It's 24% of all the shares being shorted doesn't just happen out of nowhere. There is a real bankruptcy bear thesis, and we just found out what it is in my personal view. Now, if you're like, well, hey, what is a good solar stock then? My personal favorite, And it's also well, actually, it's done pretty good the past month. Okay, this is my personal favorite solar stock that's still undervalued. That eventually it's the best one you get into. Like if you really believe in solar long term, this is the one you want to own. At only a 13 forward PE, that's why I think it's going to stretch higher. It can go to a 20 forward PE easy. But look at this company's net income. I want to own the solar company that makes this a couple hundred million of after tax net income a quarter with a fortress freaking balance sheet and great net income projections. Pretty cool. That's for solar, 13 forward PE. So hopefully that was kind of helpful there. What app is this? Hey, Light this is actually a brokerage where you buy and sell stocks on. They ask for a bunch of information. It's called Mumu. If you'd like to use my affiliate link, I actually have it linked in my bio there, linked in description on if you're on YouTube, but you're on TikTok, so it's linked in my bio. But yeah. All right, next up here. What should we look at next? What are your thoughts on Clear Secure? So Clear Secure, I actually own this company. They have been one of my best performers, and they are at all-time highs because the government can't get TSA right. There's a huge TSA shortage, and Clear Secure, if you've ever been to an airport and see these things, you can basically skip past the line. They just biometric scan. Okay, yeah, reject cookies. Sorry, Clear. Actually, I own the stock. I probably should have given my cookies, but oh well. Basically, you can go through the airport way faster. It's like Clear coverage. They have their own like section. Like it's so hard to get into the airport. Such a federally regulated industry, but they're just great. And full disclosure, I do own some shares. I don't own much, and since I have this is what you want to do when you have small positions. I didn't put much money into them. Only about 15 shares. I spent $330 buying my shares. I'm up 167%, and it's still a small position for me. So that's why I'm not going to trim a single share, even though they're overvalued right now, and I wouldn't buy the stock, and it's probably might be a decent time to sell. I'm not going to. I think in the long run, they're still a good stock. They're a money printer. Hold up. They're not just at all-time highs because of this shortage. Oh, look at the net income forecast, and look at how every quarter they beat on net income. So that's why they specifically gap up on earnings day. It's not just on fall. It's not just on news. It's that they are crushing net income projections every quarter. Revenue, look at this. The revenue is going to go from 220 to 270. Net income's going to go to 50 mil. I can't believe it. They're printing money and they do special dividends. They're making so much net income that they even do special dividends. And I've received a lot of those special dividends as well. Let me actually see if I can find that for you. Profit and loss. Last 1 year of dividends. Yeah, where's Clear Secure? Yeah, look at this. So they normally same day. They normally pay you just $3 or $2.25. They paid me an extra $3. There's another $1.88 dividend. See, that has to be a special one. See, they organically rose their dividend. I didn't buy any more shares. They used to get paid $1.88. Now I get paid $2.25 and a $3 special dividend. Again, it's not much money, but that accumulates. And I reinvested in other stocks. I don't have drip on for that. That's dividend reinvestment. But I do reinvest it in stocks. I don't withdraw that. I'm a big fan of that. All right. Cheese says, how about, I used to work at Clear Secure. Hey, that's pretty cool. Oh, hey, what's up, Fred? He says Walmart. Walmart fell big today. I can't believe it. They're usually a big defense company. I actually haven't looked into the news, but they're down 7.5% on the day. E-commerce sales surged 26%, but they issue Q2 EPS guidance below consensus on fuel cost pressures. That starts to make sense, with their trucks and stuff. So usually stocks, they can have good earnings this quarter, but if they give bad guidance, that can hurt the company. So yeah, they beat on revenue. Here's this quarter. This is fiscal, so it's not actually 2027 Q1. It's this Q2, but they report fiscal, so that's why it says 2027. But they beat on revenue. They actually beat on net income. They beat on EPS. Slightly missed on EBIT, but still, they're a money printer. They still make $5 billion in net income a quarter, and they're nearing a 1% dividend. They have a 0.8% yield, not too shabby. And I love their e-commerce business, I also like Amazon a lot. How is AMD after Nvidia earnings? Let's check it out. They're only down 1.2% on the day. How's Nvidia doing? Let me go to the mega cap watches here. So Nvidia's down 1.4, Google slightly down, Apple's up, Microsoft down, Amazon's green. Cool. All right, so yeah, I'm a shareholder of AMD. Would not buy shares today. They are a little pricey. People getting FOMO with quantum. Yeah, if you're not in quantum, I wouldn't jump in. I totally agree, especially on the super small ones like QBTS, RGT. I just don't own those. IBM could be decent. Did you say SoFi dilution their shares? Yeah, they sometimes issue shares. Like they just recently, investors weren't happy. Well, this was like probably like 4 months ago. They issued $1 billion of stock at a price. Like they actually did that while the stock was like over $30. So they did it in hindsight at a great price, like double the price today. They issued shares at $30 for $1 billion. And then what SoFi does with that money when they issue it is they loan it out, and their lending revenue is up 55% to a new record by far. Incredible growth. Hey, congrats, James. He says, happy to be in on IBM. That's a great dividend growth company and quantum company. If no one's heard the news, basically the US government basically gave, well, they burned a lot of this $2 billion dollars in some pretty junk companies at insane valuations. But they gave the most of this money was to the IBM, and that was their best investment. They paid like yeah, here it's at the bottom here. Um, IBM will receive $1 billion. Oh, that's crazy. Well, anyway, they got a huge investment from the government. And they also invested in some of these other stocks that are insanely overvalued in terms of market cap. There is no forward PE. 9 bill market cap on 20 mil a yearly revenue. It's a little tough sell to me, but that doesn't matter in this market when there's just momentum on quantum. But it's not a great long term hold. Could be a fun little short term swing trade, though. So Palo Alto Networks thoughts. Oh, actually, I saw this one first. Daryl said KSCP. Let's check it out. So this is Nightscope right here. Never heard of this one. Unfortunately, they're at an all-time low. So yeah, I would be very careful with these kind of companies. If you look in the very top right, they're only worth $48 million. And those aren't companies you really want to trust a lot of money into when they're worth $48 million. And look at this. Here's the thesis why this is at all-time lows. I can now understand. Imagine this, you buy the whole company for $48 million. You can buy it at that valuation today, or you could buy the whole company for 48 million. You're buying a business that as soon as you buy it, let's say you bought it for 50 mil, you lost 10 million of after-tax net income this quarter. So you're down 20%. Then another 11 mil, then 9 million, then 6 mil. So you're down on your investment in just a year. Um, Revenue hit 6 million, which was a record, but it's kind of tough when they have so much net income losses. So I can now understand why 16% of all the shares are being shorted. That doesn't just happen out of nowhere. There's a real bear bankruptcy thesis, and I can now see it with this net income losses. So that's the one thing that's really scary. Like, I always just like to point that out. Like, don't, like, if you're going to buy a stock, kind of understand it, look in their financials, and it's like, okay, do I really want to buy the $48 million company losing 10 million in net income a quarter? Yeah, look at analyst projections as well. Analysts project them to lose 10.5 million next quarter, 10.8 million next quarter. So that's already 20. So I would be super, super careful with that one. Hopefully that kind of helps there. I don't mean to be too bearish there, but I have to kind of mention that. And that's what I try and do. I try to show the best financials. So someone said SRE, please. Oh yeah, and then we'll look at APLD, some of these other ones. Buy some more SoFi. Oh, hey, what's up, Sermon? Yeah, I wouldn't go crazy in SoFi yet, but I certainly maybe do a slight nibble. And hey, what's up, everyone on TikTok and YouTube? If y'all are enjoying, feel free to leave a like. I'd appreciate that. Yeah, watch out for people impersonating me. I just had to ban someone. Just know I'll never follow you or DM you. I sell absolutely nothing. I have no course book, WhatsApp. I have absolutely nothing. I'm just trying to give my opinion. All I have is a YouTube and this only TikTok account, and I sell nothing. So anyway, here's Sempra Energy. They have a 2.9% dividend yield. This is a regulated utility, and I'm a fan of utilities, basically the data center tailwind, that all these new data centers are coming in the grid and they get to raise prices because of this. And they're already a good money printer. If we just zoom out on their net income, yeah, like if you average it out every quarter, they're making close to like 900 mil in net income. I'm assuming they had a little one-time adjustment back here. That's why that fell. But anyway, yeah, the net income is really strong. Revenue did decline 4%, like organic revenue did decline 4%. But 17 forward PE is pretty cheap. My favorite utility and the one I just bought is ticker symbol SO Southern Company. They're also, even though they're close to an all-time high, I can't believe this, even close to an all-time high, they're only at a 20 forward PE. And still, if you bought right now at today's price, you're getting 3.22% of your money back and a qualified dividend every year. Southern Company is one of my favorite utilities to buy. Yeah, 20 forward PE. And look, you don't just get the 3% dividend every year. You also get nice stock price appreciation. On average, 4 to 5% stock price appreciation. That's what utilities do. If you look at the VPU index, they historically give you like 9% of your money back a year. So anyway, yeah, I wish I could see their like family of brands. Anyway, Southern Company owns so many subsidiaries. Oh yeah, our companies. Let's see them all. Is it gonna like list them out? Anyway, they have like so many subsidiaries. I love Southern Company. They're a behemoth. So next up, let's look at some more stocks here. Costco had a sympathetic drop with Walmart. Yeah, I guess that makes sense. Or I wonder how Sam's Club did. I wonder if they reported bad Sam's Club numbers. Or I was in this. I thought that Walmart would have had good numbers because I heard some news that Walmart had like record signups for their Walmart Plus or Sam's Club thing to get lower fuel prices. But yeah, even if they're down 2%, they still had a phenomenal just stock in general. I wish I owned Costco. I can't own Costco. Even if they fell to like $900 again, I wouldn't buy it at that valuation. They're at a 49 forward PE, 50 times next year's net income. They're just so quality. Is it worth putting a pie on a 3x leverage gold silver? No, I don't think anything 3x leverage is worth it. And if you do, you cannot own it for more than like a day, like or like 2 days or something. You need to get in and out of those. Because historically, just the way that a 3x leverage works, what's a 3x leverage one? SQQQ. These historically, just by the way math works, always just go to zero because it doesn't go back up 3x. So historically, these just have to do millions and millions of stock splits for eternity. So that's why you have to trade these like literally instantly. And I'm not kidding. Just look how much I'm zooming in here. It's like crazy. They just continue to fall, and all the ETFs do this. So that's why, in my opinion, it's a tough sell. You got to be in and out of them. Actually, ideally, just don't own them. So someone had Iris Energy. This is a Bitcoin mining company that has converted into selling their GPUs to cloud companies. I wonder if they still break that down. So yeah, check this out. Here's the thing. So what does Iris Energy do? It's kind of commoditized at this point. They own a bunch of graphics cards. What do they do with these Nvidia chips? They're a huge customer of Nvidia. What do they do with all these Nvidia chips? They mine Bitcoin with them. That's for 2026 Q3. That's still 76% of the revenue. Or like, what was it like? Anyway, yeah. Look, but look a year ago or a couple quarters ago, this AI cloud service revenue was only 2% of the revenue. But if we go to it today, 2026 Q3, it's now 23% of their business. So they're converting from Bitcoin mining to renting out these GPUs to cloud companies. And it's still not a profitable endeavor. Like if we go to the net income projections, they're going to lose 82 million net income next quarter, 137 million net income the next quarter. The reason the stock, like they missed on revenue the past 2 quarters in a row. They have good revenue projections still at 372. But yeah, I kind of agree with Morningstar right here. Iris Energy is overvalued, highly uncertain long-term demand for AI cloud infrastructure, a subpar user experience compared to peers, and significant capex need could dilute shareholders to require caution. So yeah, look at this FCF, which stands for free cash flow, just insane negative free cash flow numbers and negative net income projections, and actually just organic revenue actually slightly declined year over year. So it's a tough sell for me. But one thing they're rallying a bunch about is an Nvidia investment. Nvidia literally buys the companies, the top companies that are their top customers. But yeah, basically, uh, Nvidia took a stake into Iris Energy. They're kind of, if you're wondering, doesn't that sound like CoreWeave? Yeah. So they do the exact same thing. Iris Energy does the exact same thing CoreWeave does. It does the same thing Nevius does. It does the same thing APLD does. And fun fact about all those companies, none of them are profitable or even going to be. And I hate to be this bearish because I know it's probably like these are so popular stocks right now, but this is the one part of AI I'd really stay away from. Like CoreWeave, man, what's their ticker symbol? Let me just go back to Nvidia because I've never typed it in. Okay, CRWV. I thought I typed that in. Anyway, like CoreWeave, if we just go to net income projections here, here's why it's a tough sell. They're going to lose 700 mil next quarter, 500 mil next quarter. They have good revenue growth. Same with Nebius. So anyway, anyway, let me not say anymore. Next up, hey, what's up, Some? SpaceX IPO next month. Hey, I'm excited for that. That's sending a lot of space stocks. All the space stocks are having major momentum, like a Rocket Lab. Hey, what's up, Monkey D. Luffy? He says Walmart is still expensive after the drop. I prefer Amazon. Me too. Amazon is even cheaper. Even though Walmart's down 9% on the day or whatever, Amazon is still cheaper. And in my opinion, they're going to be more growthy, and they have other avenues like the AWS cloud that's going to propel Amazon over. Actually, fun fact: before three quarters ago, Walmart was the number one Fortune 100 company in terms of in the whole entire world. They did the most amount of revenue out of every quarter, out of any company in existence. They did 700 million of annual revenue a year. Amazon just passed them, and so now Amazon is the number one Fortune 100 company, world's largest company by total revenue every quarter, over 700 million a year. And here's the thing: they're cheaper. They're only at a 31 forward PE. They have a literal higher net margin than Walmart has. And I love this AWS cloud business. They're the number one cloud service provider. This does over 130 billion of annual revenue for them. And look at the growth. It's up 28%. That's the highest growth rate on the whole screen. Growth rate's kicking up at Amazon. So that's why they deserve to be at this all-time high level. And I think they're just going to continue to climb higher. And that's why I own them in my buy, never sell portfolio. That's what it's called on the top left. I am never selling out of Amazon. They're so quality. HHH, is that Howard Hughes? Is that the Bill Ackman company? So anyway, if you go to shareholders right here, Pershing Square, didn't they just IPO? Hold the phone. They just IPO'd. Pershing Square's ticker symbol PS now. That's Bill Ackman's fund. So basically, Pershing Square, basically this stock right here, PS, owns 50% of HHH. They're trying to become like a Warren Buffett, Berkshire Hathaway business where they own some companies and acquire them. And Bill Ackman specifically said he's trying to acquire this one. So I think the real thesis is that they're going to be acquired. But what does this company do? I don't even know. Real estate development. So is this like a loan company, like a mortgage loan thing? Focuses on building commercial properties using the cash flow harvested from the sale of land to home builders, which helps mitigate risk. Multi-block, private management, single owner. So some sort of home builder kind of thing. And I can see why they're down the past month, because if we go to like some of the top home builders, just a basic Lennar, look at Lennar stock the past year. These real estate home builders have been getting crushed. And if you're wondering what's my favorite home builder, I actually like Cavco the most. I just bought them and they're also down the past year. But here's what makes Cavco more resilient than all the others. They have no debt whatsoever. So no debt. And look at their cash. Their cash went from 400 mil to 250. And they have no debt, by the way. They used to have 400 mil of cash, which was like over 10% of the whole market cap. Why did the cash just fall? I love this. They just did an acquisition and they projected in a year going to be accretive to their EPS in a year's time. So great news. They only usually invest like 7 mil back into the business, but they just did this huge $180 million acquisition. And here's the other crazy thing about Cavco. Last thing I'll say, because it's boring, but look at the best part is the share buybacks. They always do this, or for the past couple of years, since they have so much leftover net income and no debt, and they print free cash flow and net income, they do share buybacks, 40 to 50 million of share buybacks a quarter. Here's what that does for you as a shareholder. So again, they had a one-time adjustment. It says the net income fell 21%. That was technically had like 20 million occurred of one-time adjustment fees. So anyway, but let's just go with 44 million. So they made 44 million net income, but look at the growth rate. That fell 22%. So net income fell 22, but net income per share only fell by 19. Why didn't the EPS fall, the net income per share fall as much as the net income? Well, that's the buyback buffer. And also notice last quarter, net income grew 19% year over year, but EPS grew 24. That's the power of the share buybacks, which they can easily afford. Just look at FCF free cash flow. They're doing 40 to 68 mil of free cash flow a quarter. Net income's over usually 50 mil of net income a quarter, buying back a couple percent of the shares a year. So that's my favorite one. They don't pay a dividend. Here, I'll show you one more thing about this stock because I saw someone. Here's their website right here. They build factory-built homes. And I need to go to their investor presentation because what's so cool is you can buy a factory-built home cheaper than apartment rents. That's their pitch, and that's true, actually. Investor relations, okay. They have we're going to find the investor presentation. Here we go. I've actually gone over this on my YouTube channel, but yeah. Actually, I don't want to go through all this. Yeah. Anyway, let's go to the. Anyway, Americans are very concerned about the housing crisis right now, and I wanted to find that ownership at monthly cost comparable to apartment rents. You can own a house comparable, then they have the actual homes here, and they list that. But anyway, this is what they do. They just built these HUD home houses. They built some of these as well, communities, but they have park models as well that are really popular. But here's the best part. No debt at all, literally zero debt, 250 mil of cash. And again, they would have had 500 mil of cash, but they just did that. Acquisition. And yeah, so look at that, 290 mil a share buyback. So anyway, yeah, there's the 170 million for strategic acquisition of Homestar. There's some more of the financials. So anyway, I won't spend too much time. I'm spending way too much time on this stock, but I own them for a reason. They're only at an 18 forward PE. Remember, they're worth $3.77 billion. They're buying back a couple percent of that company a quarter or a year. Anyway, here's my position. I'm slightly up on them. And why am I going over this company? They report earnings in 3 hours. So in 3 hours from now, they're either going to go up or down a bunch. And I'm kind of worried because, again, they're down 17% the past year. That's because all the home builders are. If you basically Lennar, even a Home Depot, this stretches out to everywhere. Look at Home Depot, the daily chart. Home Depot's on this massive downtrend as well, going from 430 to 300. So anyway, that's the real estate sector. You could play Home Depot, Cavco, maybe even a REIT. So I'm so behind on the chat. I do apologize, but hopefully, if someone maybe appreciates the deeper dive analysis, I know I kind of. Do you still feel good about HCA? I grabbed a few shares today. Absolutely. This is my largest holding in my Roth IRA, and I also just bought another share recently. But look at this. I'm down 15% on my position, but I'm not worried at all. If we go down here, um, I just bought a share at 429. Well, it's 390 today. So I bought one at 468, and I get nice dividends from this company as well. This is one of my favorite share buyback companies of all time. If you're wondering what is this company, they are the largest non-governmental hospital group in the world. But one thing that's hurting, the reason the revenue's down right now is because their respiratory visits. Yeah, check out this first line right here. Or revenue growth was only 1.3%. Same facility admissions rose 3.1%. Revenue per admission grew 3.1%. But look at the offset by a 42% decline in respiratory-related admissions and winter storm impacts. So the respiratory business, I guess, is seeing some weaker sales. But anyway, they still print net income every quarter. This is what I love. They make 1.8 billion in net income a quarter. When you own a company, you just want to see two things. Like massive EPS growth, dividend, share buybacks, quality business, and they do that. I trust hospitals. It's like they're not going to get hurt by AI. They'll probably be beneficiaries of AI and robotics in the long run. But anyway, if we go to EPS right here, earnings per share, look, that's up 10% year over year. Last quarter grew 44, 44, 23, 8. And a lot of that is fueled by share buybacks. So yeah. Oh yeah, look at the free cash flow. So they're making, if you average it out, usually, wow, look at those 2 quarters there, crazy free cash flow. So they're usually making, if you average it out, well over 1.3 bill of free cash flow a quarter, over 2 billion of net income a quarter. They are a little bit leveraged, but here's why it doesn't concern me, because the best part is the share buybacks. If you look at the top here, they're spending like $1 to $2 billion of share buybacks a quarter, and look how much the dividend cost. It only cost 183 million. That they have so much room to raise the dividend. When remember, they're making over like 1.3 bill of free cash flow a quarter, 2 bill in net income. They have less than a 10% payout ratio. It's like an 8% payout ratio for a dividend yield that's actually higher than this. They have like a 0.85% dividend yield. So anyway, HCA is a cool hospital group play. And a lot of the hospitals are also on this recent downtrend. If you look at like a THC, Tenet Healthcare, that's the second biggest, I believe. They're at a 7.7 forward PE. But HCA, I think, is a little superior. But yeah, hospital operations, ambulatory care. It's a sector I just am a fan of. Like or not profiting, but I just mean like it's just like defensive. And you just want it as a small little bit of your portfolio. That's my exposure to healthcare. So yeah, I own HCA Healthcare. It's actually my largest holding in my Roth IRA. I got 6 shares. I just love buyback and dividend companies. Oh yeah, we forgot to look at Nvidia. Do I keep or sell Inu? Oh, that's a good question there, Micron. So let's look at Micron, then we'll actually pull up Nvidia, Eaton. Sorry if I'm behind here on the chat. I do apologize. What's up, Shahib? Um, Loblaw is always doing share buybacks. Which ticker symbol is that? So we'll check that one out. Oh, with TSE, I don't think I can view that one because it's like a weird exchange. Hey, Arthur, what's the ticker symbol for that Medics Group stock? Let me know. We'll check it out too. But anyway, here's Micron right here. Here's what makes me like. Here's why it's hard to be super bearish on memory right now. So obviously, on a technical point of view, Micron's at an all-time high. It's obvious this thing's overbought like crazy. But here's the part that's like makes it hard to be bearish: the forward PE. So they only trade at 8 times next year's net income. And that assumes they don't beat on net income, but here's the actual net income projections for the next 2 quarters. It's supposed to be 22 billion of after-tax net income, and then 26 billion, and it's supposed to be like 28 bill the quarter after. So that forward PE for next year's EPS, they're only trading at 8 times next year's EPS. So in 1 year's time, you're going to look at the trailing 12 months PE, it's going to say 8. And basically, this is a super cyclical market, though. And yeah, Samsung workers threaten strike that impacts 3% of global chip production. There's a huge memory shortage right now. Memory chip prices hit record amid supply chain shortages. Yeah, wow. Micron Technology forecasts sixth most profitable U.S. stock with nearly 100 billion in revenue. Dude, or no, 100 billion of revenue a quarter is what they're gonna have, which is crazy. Amazon does like 200 to 270 bill of revenue a quarter. Yeah. Anyway, revenue projection in 2 quarters going to be 40 billion. Anyway, it's a way to play the memory shortage, but it's really like the long-term thesis. You do want to be careful because next year or the year after, because this is a cyclical market, the supply chain will fix. It's going to be peak EPS ever, and it will never get back to that level. So it's either next year or the year after. It's going to be peak ever EPS, and it'll never get back to that level. But I really wouldn't trim it. I think it could go higher, maybe stretch up to like a 15 or, well, no, maybe not that high, but like a 12 forward PE, send it up another 40% before it maxes out. So anyway, here's Nvidia stock. They reported earnings yesterday, and if Nvidia is only down 0.5%, that's a win in my book because that's nothing. But when you know what the real L is the market makers, because the option market implied an 8% move either up or down yesterday. And this is what I constantly see in the stock market. The option market implies a huge 8-10% move on recent stocks. And here's what they do. They do nothing. Everyone gets burned. The calls and the puts get burned because it only moved 0.7%. The leaps, so anyway, Nvidia had great earnings. To simply put, they beat on revenue, crushed net income. They had a slight adjustment to the net income. It wasn't actually 58 billion. They realized a gain. So look, here's the before tax number. Before tax was 53. After tax can't be 58. That's because they realized a gain. But anyway, look at this before tax number. This is why Nvidia is the world's largest company by market cap. They made 53 bill, and they would have made like, I don't know, 45 billion of after-tax net income. Yeah, here's last quarter was 42. So the net income continues to climb. Yeah, next quarter, look at the forecast. It's still going to have 100% EPS growth. Net income's going from 31 to 57 bill in net income. And so the forward PE, this is why Nvidia is shockingly cheap. Even at all-time highs, it's hard to be bearish on Nvidia. Don't short this thing. If you're a shareholder, hold on to your shares and don't trim. Forward PE is only a 22. That's actually so cheap, man. I might even look into buying Nvidia if they're on a real dip. I kid you not. I mean, they have a fortress balance sheet, number one GPU market share, the picks and shovels plays, doing a ton of investments. We can actually see the Nvidia investment portfolio. Nvidia is so big, they own a bunch of Intel, CoreWeave, Coherent, Synopsys, Nokia. A lot of these are circular because they're buying a lot of their main customers who keep buying a bunch of orders. But yeah, let me get my water here. Would you recommend not buying Ouster till it drops more? Yeah, I would wait for it to drop more. JV said, what app is this? So, hey, I'm actually on a brokerage right here. It's where you buy and sell stocks on. If you're interested in buying, selling stocks, it's my favorite brokerage. So it's actually, I have it linked in my profile description there. Or like LinkedIn bio, it's my affiliate link, but you can just type it into Google. This is a brokerage called Moomoo. Yeah, if you sign up and deposit $100, we'll both get like a free stock if you sign up with my link in bio. I also have Robinhood and Webull as well. These are also two great brokerages, but these ones make you pay monthly subscriptions, like $5 a month for a lot of features and money. When this one, there is no monthly fees, there is no even subscription. It's completely free. I love this app. Costs nothing. No fees at all, no hidden fees. It's best brokerage in my opinion. See this app, I own their stock as well. I own Moomoo stock, they're publicly traded. I own Webull stock, and I own Robinhood stock as well. I also own SoFi stock. I'm a big fan of the fintech industry. Next up, I saw Bull earn. Oh, Steven actually said Bull earnings tonight. Yeah, speaking of Webull, that's actually this brokerage right here at the top. As you see, it's called Webull. Here's Webull stock publicly traded, another brokerage. I do own a little bit of them. I'm really bullish on just the revenue growth. I am actually really excited for earnings. I didn't know Webull was today. I think they're going to beat on revenue, but the bad part is they're a little pricey, but they just got net income positive. But yeah, look at that forward PE. Well, the trailing 12 months, they're at -7, but the forward PE is positive. They traded at 51 forward PE, which means they trade at 51 times next year's net income, which makes them look pricey. But my bet is that Webull's going to beat on earnings, specifically because right after they IPO'd, this is what they just added into the platform for the first time ever, which I never recommend doing these, but they just added in prediction markets where, like, this is all speculation. Never do prediction markets, really. Um, and they also just added in crypto where you can now buy crypto and do prediction markets on this brokerage. And that is high margin commission stuff. Robinhood disclosed that every time you buy and sell a stock on a brokerage, they only keep a 0.1% fee. But whenever you buy and sell a prediction market contract, they keep a 2% fee. It's 20x more valuable for their bottom line. And that's why when I saw Webull introduce, and they're pushing hard this prediction market stuff, especially around the Super Bowl time, um, I think they're going to beat on earnings and have higher net income than projected. And I don't know. Anyway, that's my prediction. Again, really expensive at a 51 forward PE. Unfortunately, Robinhood is also really expensive. Robinhood's the most high quality pick. Like if I was going to pick one, like Futu, Robinhood, Mumu, and then Webull. But yeah, even Robinhood's at a 37 forward PE. But I really love Robinhood, Interactive Brokerage, SoFi, all the fintechs, the picks and shovels that Calypso. They all have super high margins. I should, except for Webull, but I love the high margins they have. So, what do you think about Navitas? I would actually avoid that one. Um, I'll show you why in a little bit, but I actually have really bad news about Nvidia Semiconductor. Um, and I don't want to be bearish, but that's one I might have to go into, but I feel bad. I wouldn't touch that one actually. As an HCA employee, we get employee stock purchase at 10% less than market price up front. You're lucky, JB. That's because I look at this. I need that because I'm down 15% on my HCA shares position. I'd actually see if you can maybe get some shares today or something, see if you can lock in today's prices. I genuinely believe they're going to go up from here. They're at the risk reward is looking very fair. So check out HCA, see if you can get it 15% even below. It's 27% fall it's already had. If you can lock that in, JV, I think that would be smart. Even if it's just a one or two shares or something little, just one share, that would be worth it for it just to, invest for your future and you get the dividends. So anyway, let's get to this next stock here. I saw Eaton. This is an electrical infrastructure company and they have an aerospace business, but I'm super bullish on electrical infrastructure. The whole electrical super cycle, these data centers need the complex electrical work done and they do it. Electrical Americas grew 20%, driven by data center strength. So there we go. Oh, what was the aerospace? At the third line, aerospace sales rose 16% to $1.14 billion with record 27% operating margins, aided by a facility sale. Mobility sales declined 2%. So anyway, let's see how their valuation is. So they're currently trading at 37 times EPS, but only 30 forward PE. So only 30 times next year's net income. Yeah, check that out. Aerospace is 15% of the revenue. Small chunk is mobility. Yeah, I'm a big fan of the electrical super cycle. And look at the net income forecast. They're supposed to hit 1.22 billion. Sorry, had to get my water there. They're supposed to hit 1.22 billion of net income in 2 quarters, and it's never even been close to that. So that's what's kind of cool. There is still growth, and again, that's reflected in the forward PE. And if you buy the stock now, you get a 1.1% dividend yield. So it's like a dividend growth stock. That's a good yield. I will never do options. Hey, that's a good thing. The thing is, you can get option type returns just by buying and holding high quality stocks and just holding them even after their gain. What's up, Nate? He said, what's my year to date? Well, in this portfolio, I'm up 64% year to date return money weighted. But in this portfolio, I'm now green. Okay, I'm up 0.48% year to date in there. And then in my Webull portfolio, we're up, can we do year to date? Yeah, let's see, year to date. We are up 6.67% year to date in here. And we've gotten $140 in dividends. No way. Let's actually check that out. What? I think it was that major payment from, Progressive and Futu. I love companies that do surprise special dividends. I wasn't even expecting this, but both of them are so profitable and made excess money that out of nowhere, because Progressive, if we look at the bottom, historically, they only pay me 45 cents a quarter. but they just did a massive, they had massive premium. So they did a 55, or I got $55 or a 13-cent dividend, $13.50 dividend. Futu did a 260. That's the Mumu brokerage. They're printing money. I actually predict Futu might even do another, or they're going to do massive share buybacks or dividends. I think Futu's a steal of a deal. If you're wondering what is Futu stock, again, that's actually this app right here. You look at the top of my screen, this application, or this is a brokerage. It's called Mumu. Well, Mumu is publicly traded right here. Yeah, if you look at the top left, this stock right here is called Mumu. And here's what I love about them. They have so many users. Yeah, 200 or 29 million number of users. And the best part is they print net income, At least it's safe to see, or for whatever reason, if this company were to go bankrupt, all your assets are safe, 250K FDIC insured. But this company is not going bankrupt. This is why I love brokerages. They made 433 million of after-tax net income. Before tax is 532. Revenue's up 44. Net income's up 80. So that's net margin expansion. Check that out. 52% net margin of 25%. So anyway, yeah. And if you'd like to get this brokerage I'm on called Mumu, I actually have an affiliate link linked in my bio. I saw someone ask about that. Yeah, it's called Mumu. Oh, and I have an affiliate link. If you deposit $100, you both get like a free stock. But yeah, look at the valuation. A 10 forward PE. They're one of the cheapest in the market. So that's why I love them. And they have this special dividend. So anyway, I love food too. Healthcare is generally a safe bet. Yeah, I agree, ODB. Especially if like tech starts to fall down or something, maybe these healthcare companies can be defensive. Another one of my absolute favorite healthcare positions, and someone's going to click off and think this is boring, but the stock will fascinate you, especially if you like dividends. If you buy AbbVie right now, here's my thesis. If you buy the stock, you'll get 8% of your money back a year, which slightly underperforms, or 7 to 8% of your money back a year, which does underperform the S&P 500, but this does well in a lot of environments. So if you buy AbbVie right now, you get 3.3% of your money back every single year as a qualified dividend. And that's taxed at long-term capital gains, which for me, even in my taxable account, is 0%. So you're getting 3.3% of your money back tax-free. If you make under 48K a year, it's tax-free long-term capital gains. And here's why I think on top of the 3.3% dividend, you're going to get 4 to 5% stock price appreciation. What does AbbVie do? They sell a bunch of prescriptions. Here's their largest prescription, Skyrizi. Check out the year-over-year growth rates. It's up 31. After it grew 70, after it grew 47, after it grew 45. Like these year-over-year growth rate, it just is on a streak of growth. And not just their largest prescription, they also have Renvoc, or however that's pronounced, is up 23, after it grew 57, after it grew 59. Like it's always 50, 60. Like they are on a massive streak of growth. And they have a bunch of other ones. Like I won't go through all of these. Like what's this one? Botox Therapeutic. That's up 16.5 to $1 billion for the first time ever. That hits a record every year. So anyway, that's what's going to fuel the 5% stock price appreciation on top of the 3.3% dividend you get. And the valuation's very fair. Only a 22 forward PE, where they trade at 22 and a half times next year's net income. That's super fair. Oh, AbbVie, and there no way they're actually getting in the weight loss prescription. AbbVie is open to combining obesity assets, city on cites unprecedented market opportunities. Well, that sounds like a cool tailwind in the future. But anyway, cool healthcare stock. I do own, and I'm down on my position. I'm down 2.25%, but I own them for a reason. They seem pretty cool. I don't own many shares either. I only own 3 shares, but it's a nice defensive dividend growth stock, and I trust them. So Adam said Elf, yeah, beauty and cosmetics company. Hey, what's up, Nate? You're going to love this. SIVEF. All right, we'll check that one out. And Celsius. Hey, I love Celsius. We'll check that one out too. It's like an energy drink company, and MXL. Sorry if I'm behind. I definitely want to get to all these, and I'm sorry if I'm missing these, some of y'all stocks. But yeah, Elf Beauty right here. I'll go quicker with the stock analysis. I apologize. But yeah, anyway, they're at an 18 forward PE. And that's how you really want to value this company, because they just technically had some net income adjustments from their acquisition. Or wait, it says they lost 49 million. Yeah, the core business actually made $7 million. Why did they have that? It was an acquisition related expense. Notice how their balance sheet changed drastically that quarter out of nowhere. We're from 1.3 bill of assets to 2.3 bill of assets. That was because of this acquisition, and they just occurred like a one-time fee because of that. Sent the net income negative. So the real way you want to value this company is off next year's net income. And analysts forecast an 18.8 forward PE. So that would make this one slightly undervalued, actually, at an 18 forward PE. And they sell a bunch of beauty and cosmetics stock, or a beauty and cosmetic stuff. I mean, like, I don't know, like eye stuff. I don't know as a guy, but I wonder if can we find some products. So yeah, like this kind of stuff right here. There we go. Another huge one, if you're a fan of that industry, you'll also love Ulta Beauty, which you might even trust more. That's also on a downtrend. So it's not just Elf that's on a big downtrend. Looks like Ulta Beauty, their main competitor, is also on a main downtrend. Here's why you'd maybe want to trust this one more. Check out their net income every quarter. What was Elf making? Like 30 mil, 40 mil of net income a quarter? Ulta makes 2 to 300 mil in net income a quarter, and they mainly spent all that money on share buyback. Super buyback friendly company. All right, next up here, SIVEF. I wonder if I can find that one. Okay, Silver Semiconductor. Then we'll do Celsius. Cool. Okay, they just reported earnings last night. I think Nvidia did. Yeah. Or you're saying this company right here. So they're up 8.5% on the day. They're worth 1.87 billion. So they're still a really small company, only worth 1.8 billion. So we'll convert the currency to US dollars. It looks like it's a Swedish company. So they do wireless and photonics. I heard this is like a growing industry. How's that growing? Oh, look at that quarter. It boosted up. Well, it's only 3 million in revenue. That's why. Very small company. So they're headquartered in Sweden. Yep. But they're not profitable yet. This is in US dollars. Still losing like 5 mil a quarter, but that's no big deal. Anyway, I think this is just getting tossed in the momentum basket of semiconductor hype stocks. I would be careful with that one. So Celsius, this is a really cool energy drink company. They now own Alani, and Alani is huge, and Rockstar Beverage, which they got from Pepsi. Pepsi took a stake into Celsius, and in exchange, does all their distribution, bottling, and giving them Rockstar Beverage for free in exchange for the company. So it's actually a huge new partnership that they had. It's really cool. And on top of giving them money. So Morningstar actually says they're undervalued. Strategic acquisitions of Alani Rockstar combined with the PepsiCo partnership will drive long-term value growth in the fast-growing ready-to-drink energy category, though intensifying competition requires caution. So what makes me happy is the low valuation. I think the risk reward is starting to look decent. It's now not the time to go all in because all food stocks are really struggling. Like if we just look at a boring consumer like a General Mills, is a great example. We saw that massive downtrend on General Mills. It's also kind of Celsius is no exception. They're also on that downtrend. But look at the forward multiple. They're only at an 18.2 forward PE. Or they only traded 18 times next year's net income. Yeah, they're supposed to make 102 mil in net income next quarter, 109 mil next quarter. And they had a one-time adjustment from moving to Pepsi. It says they lost 61 mil. They didn't actually. They had a one-time termination fee from moving to Pepsi. So the core business made 166 mil. Says they lost 61 mil. That was artificial, wasn't real. So it said the EPS was negative, artificially hurting their trailing 12 months PE. That's why you do a forward PE. But yeah, speaking of intensifying competition, Monster Beverage is at a near all-time high. Monster has actually been one of the best performing stocks in history. I mean, check that out. I mean, that's just like, wow, it just continues to hit new highs. They mainly because they print net income and have no debt. So here's Monster's net income, and this is what I hope Celsius will turn into one day. They just print 500 million net income a quarter. They have so much organic marketing where they spend like not a lot of money on marketing as you expect. But look at this balance sheet right here. This is phenomenal. They have no debt whatsoever. And sorry, I'm like really tired right now. So I'm like, and we've been streaming for well over an hour. So I appreciate everyone that's here. But yeah, check this out. Monster has literally no debt and a ton of cash. So they deserve to be at all time highs. Thoughts on Arista Network? This is a phenomenal AI infrastructure company. Let's check it out. Hey, thanks for the follows. Yeah, if you wanted to follow button, I stream every day. I'm probably gonna end the stream in a little bit, but yeah, basically I try and stream every day. I just look at y'all stocks, analyze them, and chat. Their year to date is 1200%. No elf dirt. Oh, hey, what's up, Nate? Okay, here is Arista Network stock. I am super impressed with this company. The only bad part is they're expensive. Oh yeah, hey, we'll look at MXL next. I promise that's the next stock. MXL next. But check out Arista Networks right here. This is super impressive. If we look at the revenue, it's never been higher. They did 2.7 billion in revenue, and the growth is phenomenal. It organically grew 35% year over year. Like they didn't acquire a company to get this growth. This is just the growth the business is just organically having. And so the revenue is growing. What about the net income, the after tax net income? Also at a record. This is what justifies the high multiple and why they've had so much stock price appreciation. They've earned it because This is impressive. The net income just continues to like hit a record every quarter. Just this quarter it was over a bill of after-tax net income. It was like a bill last quarter bill. So it's gonna, and if we go to the future projections, yeah, it's projected from now on to be over a billion in net income a quarter. So I'm super impressed with the Arista Networks, and don't they? Yeah, really good balance sheet as well. So, hey, no way, Puck. It's good to see you, man. I hope you're having a great day. Yeah, if you got a stock you want me to look at, let me know. Thanks for all those roses. So here's MaxLinear. Oh, this is a SpaceX stock, I believe, or maybe it's a memory company. I don't know. Is there any specific news? Oh, wow. So if we scroll back to the chart up here, they gapped up like crazy. Uh-oh. I think my thing just froze. Hold on, I can fix that. Um, Sorry if it's lagging here, but anyway, they gapped up specifically on earnings day, which means they must have reported something good. They launches USB solutions for AI data centers and Trinity Wireless platform. So it looks like they're doing some solutions for data centers, and that might be why the stock just boosted up. Oh, look at the revenue forecast. Forecast is good too. They're supposed to hit 173 mil of revenue, and they're actually supposed to finally get net income positive. No way, they're gonna make 1.8 million net income. So that actually is okay. Sorry, my dog just knocked on my door. Thought it was a person. But look at this right here. Um, they lose. This is a tough buy today because look, they lose like 20, 30, 40 mil in net income a quarter. But the forecaster, I can see why the stock has had so much positive momentum. They're actually supposed to get net income positive in 2 quarters. So not just the revenue is going to grow like crazy. Revenue's going from 120 to 170, but the net income is going to go positive, which is pretty insane. So they do communication system on-chip solutions for broadband connectivity. Yeah, look at the growth rate. Revenue was up 43% year over here. So did I even see that? Oh, I completely missed that. No wonder. Okay, that's great growth from its a decline. They're up 43% from the previous year. So anyway, I don't know if I'd buy the stock today at 1,500 forward PE. I actually definitely would not buy the stock today, but I can kind of understand the rally because you really want to do like a multiple year out net income multiple because they're going to get net income positive in 2 quarters. Interesting. Yeah, don't buy it today. I agree, Anthony. What app you using? Yeah, hey, Peace. This is actually a brokerage where you buy stocks on. They ask for a bunch of information. You can just Google Mumu. If you'd like to use my affiliate link, I actually have it linked in my bio there. It's if you end up depositing $100, we'll both get like a free stock. But yeah, brokerage called Mumu. Oh yeah, let's do TXMD. I wanted to check out. Wait, hey, Arthur, what's that? I asked, what's that ticker symbol? Or I'll just find it. I got you. Oh, it's TMDX. Okay, so here, this is a liver company. So this actually does like liver transplants, and so yeah, check this out. If we go to their liver revenue right here, it's actually had phenomenal growth. It's up 28%. After grew 62, after grew 190, after grew 193. So just hits a new record every quarter. I mean, phenomenal growth. How about their heart revenue? That's 17% of revenue. Looks like slower single digit growth, 6% growth. But anyway, when we combine all the businesses together, this is what's attractive about the stock. I mean, 2020, who's buying this? They're doing 7 mil of revenue a quarter. Well, check them out today. 173 mil of revenue. But what about profits? Are they profitable? I'm also curious. So the profits, okay, this is the one bad news. So the revenue grew 21, but the profits fell by 51, and that's real. So I'm assuming like, yeah, gross margins fell 5. I wonder what happened with margins this quarter. I wonder if there's any specific news. Let's see. National OCS program fueled revenue growth with OCS transplant revenue reaching 167 million of revenue, up 80%. So operating expenses rose 45%, driven by R&D for next generation OCS and increased SG&A for business expansion and finance lease costs. So that might be the margin problem. The company ended this quarter with strong cash balance of 460 million. Do they have debt? Let's check out the balance sheet. Okay, so they do have debt, but they have a net cash position though. So they have more cash than debt, which is great. Or actually, I don't know about that. Wait. Um, Let me double check. I mean, 900 mil of liabilities. What's the long-term debt on that? I don't know. So 500 mil of long-term debt. So they have actually a like 50 million net cash position. Okay, that's good context to know. Anyway, so that's definitely why the stock is struggling. If we're wondering why did the stock, gap down on earnings, it's that margin collapse. So the forward PE is a 23. That's actually cheaper than or not cheaper. AbbVie's cheaper. AbbVie is the same multiple. Hey, what's up? Jay Ewing, what's up, man? Thanks for that boxing glove. I appreciate that. If you got a stock you may look at, no way, dude. Those boxing glove. That was really cool. I just saw it, dude. Thank you very much, Ewing. If you got a stock you may look at, definitely let me know. I greatly appreciate you. That's very kind of you. And then Tim P21, thanks again for that gift as well. Brett said, could you do Palantir? Sure. This is a phenomenal defense stock if you're a fan of if geopolitical stuff starts to escalate again, this one should be a big beneficiary. Palantir seeks to bid on U.S. Defense Intelligence Agency data analytics contract. I guess that's interesting. Oh, RITM. All right, cool. We'll do RITM after this. How you do analysis, it's impressive. Do you offer mentorship? I actually do not. So full disclosure, I actually sell absolutely nothing. So I have no course, book, I don't mentor, coach, I do absolutely nothing. But what I do have though, and I have a private Discord. Well, technically you have to go over to the YouTube stream to like find the link to it, but I have a Discord. It costs $1 to join the Discord, and it's basically if you just have any questions or need help with the stock or want some personal analysis, I'll do that for you. It's $1 just to keep bots out of there. Or if you become a YouTube member, you also get access permanently to the Discord. It's a $1 permanent access thing, or you can become a YouTube member one time and then cancel permanent access. Either way, but that's the only way to guess. Like if you want me to help you out with the personal situation. But sorry, I didn't mean to self promo. It's only $1, and there's only like 20 people in there. I like that it's a small community. So anyway, let's check out Palantir right here. Sorry for kind of self promoting, but anyway, I love the growth of Palantir, especially from their government business. This is the highest growth rate on the whole screen. Government revenue grew 76%. That's the highest growth rate on the entire screen. And all the other growth rates are still very impressive. Last quarter was 60, 55, 49, like insane growth. That's why this company is so expensive. That's the one tough part. It's still really hard to buy Palantir at a 90 forward PE and at 63 times revenue. Not 63 times net income, 63 times their sales. But check out the commercial side. This is the more growthier business, even more impressive. Commercial side revenue is up 95. Up 95%. That's the highest growth rate on the whole entire screen as well. No wonder they're doing so well. They keep beating analyst forecasts. The orange line is what the analysts expect them to report every quarter. And notice every quarter they beat by a good chunk. So record net income this quarter by far. That's why they're so loved right now, and a fortress balance sheet. They literally have no debt whatsoever, completely debt-free company, and that's why I love Palantir. I'd love to own them one day at a cheaper valuation that I can pay, but I'll probably never get a cheap valuation because they're so quality and will never get cheap. No way. Now, to get political, looks like president purchases 630 in Palantir stock and publicly endorses defense AI company Dell Technologies to offer Palantir's AIP platform on premises. Palantir faces European resistance as Germany and UK seek alternatives to US military software. There's some of that geopolitical fears. Um, anyway, there's some news on Palantir. Hopefully that was kind of helpful. So let's check out RITM. Thanks again, man. So Rhythm Capital. I think this is a BDC right here. This is an interesting company. What you own, I think you definitely know this already, but this is a BDC, which stands for a business development company. And basically, by law, these companies have to, by law, pay out 90% of their taxable income in the form of a dividend, or else they're taxed like crazy on that money. So if you go to any BDC, like a Main Street Capital, Ares Capital, Blackstone Capital, they have really high dividend yields. You're like, okay, is this sustainable? It actually is sustainable because they're a BDC. But at the same time, these dividends actually aren't taxed as dividends, because dividends from any other company like McDonald's, AbbVie, Verizon, AT&T, whatever, those dividends are actually taxed at long-term capital gains, which for me is 0%. But these dividends are actually taxed at short-term capital gains when you receive them, which means you do pay a little bit of a higher tax bracket on them. So basically what you do, you buy this to maximize your dividend income. Although, one note, they don't appreciate too much in stock price. Or look, since 2020. In 2020, it was $17, and now it's $9. But hey, it doesn't really matter. All you ideally want is you have a 10.8% yield. You want 10% of your money back, and then you hope for it to stay flat, or just 1% stock price appreciation a year. So another, my favorite BDC is actually Main Street Capital. These are for dividends. See, this one is actually higher than it was in 2020. What's cool about this one, that one does first lien, second lien loans. Main Street Capital also does first lien loans, second lien loans, but they also do preferred equity and take stakes into their companies they loan to. And so they've been a little more growthy. So they have an 8.3% dividend yield. It's slightly lower, but I think the stock price appreciation makes up for it. So anyway, there's Rhythm Capital. And I know lending's kind of been rough recently. And it's not just them falling. All the BDCs are struggling. So those are actually ideal to hold in your Roth IRA. I own another type of company that has to pay out 90% of their taxable income in the form of a dividend. It's another one that doesn't pay qualified dividends, but this is CTRE Care Trust REIT. They have a 3.5% dividend yield, and they do triple net lease real estate on a senior housing care, skilled nursing facilities, specifically people with dementia. And they have literally, I should go over this because I promise it'll impress you if you're a fan of higher yielding stocks. So it actually has slightly higher 3.5% dividend. And check out the growth of the revenue. Revenue has been explosive. It's up. Oops. Oh yeah, here's a video I made. I actually made a video analyzing this one not too long ago. But anyway, revenue is up 47% year over year. And triple net leases are insanely high margin. Literally 95, 98% gross margins on their triple net leases, 50 to 80% net margins. And the best part is their fortress balance sheet. Care Trust literally has one of the lowest leverage of any REITs that exist. They're actually, I'll go to their website right here. I'll be super quick, then we'll get to the next stock here. But basically, they're worth 10 bill market cap, 12 years of consecutive dividend increases, FFO payout ratio. This is FFO. What is this? This is the net income plus the depreciation and the amortization, which is super important for real estate triple net lease properties. So their dividend, basically point is, what's their dividend payout ratio? Is their dividend sustainable? Yes, they only have an 81% payout ratio. And they're keeping a little bit of their money and paying taxes on it to reinvest in new properties. 10-year average historical investment yield. But this is the number here. Net debt to EBITDA of only a 0.6x. So they can pay off all their debt in 0.6 years, which is super rare. You look at like a Realty Income, an ADC, a PLD, an American Tower Corp, any of these other REITs, they all have like 5 to 6 years of net debt to EBITDA. But this one only 0.7. So I'm a fan of going for REITs with like really good financials. So actually, I bought a share this today. I should mention that. Forgot about that. I bought a share literally right before the stream. Even though look at this. I'm not scared. They're up 38% the past year. But you get 3.5% of your money back in a dividend every year. And also they're in my Roth IRA, so these dividends are tax-free. Pretty cool. Let me know what y'all think. So let's keep going here. Sorry if I'm spending kind of too long on this. On each stock here. I'm having so much fun here. I appreciate y'all telling it to follow button. I appreciate that. So what did I want to get to next? What's up, Egg Mayo Sandwich? It's good to see you, my friend. Any new additions to the portfolio? No new additions, but I have just been buying more of my favorite stocks that are on a dip. You know, what I constantly do is I raise my cost basis. I just want more shares of companies. Like, look, I just bought a share of Coca-Cola Consolidated. Hey, we just saw Celsius is on a massive dip. Coca-Cola Consolidated, the bottler for Coca-Cola, is on a dip right now. And they're only at a 24 PE. So I think that's pretty fair. See, I was buying shares lower. I was buying shares at 145. And I was even buying shares, down at 105. I don't mind raising my cost basis because they're so high quality and I think they're going to continue to climb. Amphenol, this is a copper cable provider for Nvidia and for Google's TPUs. It's another one where I bought most of my shares down here. My cost basis is at 71, but I continue to raise my cost basis buying shares, at today's prices. I just bought one a couple of days ago. So those are my most recent purchases. All right, let's get back to y'all's stocks though. Sorry. All right, next up here. Ooh, I saw FICO, APLD. Hey, what's up, Billy? Maybe I'll do APLD. I don't have too much good news about that one. That's just a data center leasing company. Kind of the same. Actually, Nvidia just completely sold out of their APLD position, and they just bought Iris Energy, which is their competitor, and they just bought more CoreWeave, which is kind of weird. But we'll check them out, actually. Hey, what's up, William? I hope you're doing well as well. Check out Ouster. They just released new color LiDAR. You're right, William. The world's first native colored or just colored LiDAR. Well, actually, remind me to get to Ouster after this because I have like two stocks I want to go over first. But I am freaking shocked. I literally bought this company, and I don't recommend buying it now, but I bought this company literally a month and a half ago. There's my buy order. I only bought 4 shares, kind of wishing I bought more. And in just a month or so, I'm already up 103. That's super rare. So, and just doubling in a month does make it technically overbought, but they deserve the hype because how quality their products are. Autonomous vehicles, robotaxis are using LiDAR, and they're using it for military drone defense purposes. They just got like a military contract. So I want to go back to Ouster after this. I'm like all over the place. Sorry. Hey, and Dave, man, dude, thanks for that gift. I appreciate that. If you got a stock you want me to look at, Dave, let me know too. Sorry if I'm behind. So anyway, here's FICO. What this company does is how they got their model is, you've probably heard of the FICO score. Every time you buy a big ticket purchase like a car or a house, you pay a couple dollars, like $5 for your FICO score. But what they've had recently, these past 3 years after COVID, is pricing power. So whenever you're buying a house for a couple $100,000, they've risen their price by more than they slowly have been doing price hikes like 10% every like quarter of their FICO score. And no one cares because who cares if you're paying now $12 paying for your FICO score and hidden fees? You're paying $12 instead of five on a $500,000 house, or you get what I mean? So they just have massive pricing power. But there's one bad news, and the reason the stock continues to gap down, and no earnings day, there's random days where it'll gap down, is because of a new government scoring business called Vantage Score. So there's now new competition that they've just never had before. So the third line here on the bears say the decision to allow Vantage Score for government mortgages will alter its pricing strategy, could result in Vantage Score gaining traction in both mortgage and non-mortgage markets. So basically, that's the only thing really weighing it down on this stock is that new competition. But I think it's still a slight tad expensive. This is the one only bad news. They're still at a 29 forward PE. So that means they're trading at 30 times next year's net income. That's still a slight bit pricey, but they're quality and they deserve it because they just had an amazing quarter. They had a huge beat. Revenue was 620, or orange lines, what analysts expect. They expected 620. They did 690. Net income expected was 225. They did 265. I couldn't believe it. So that was really impressive. Do you invest in U.S. markets or do you explore other regions too? Yeah, I do own one ADR. I try to keep my ADR exposure super low, but just for simplicity purposes, because there's always a quality stock in the U.S. But anyway, my favorite ADR stock, Chinese company, is actually Tencent. This is the number one video game company. If you've heard of Riot Games, which is League of Legends, Valorant, they own that fully. Did you know they also own 49% of Epic Games, which is Fortnite? So they own half of Fortnite. They also own Supercell. So you heard of Clash of Clans, Clash Royale. They own that. Anyway, let's go to Ouster real quick. So yeah, this is that lidar company. Actually, they're still down bad from their IPO. This is why they might still have more room to run. But here's why also you want to keep it as a small position. Sorry to get my water. They're still a money loser. But we'll look at specifically what I love is how they narrow their losses. They lost 20% less than the previous year as their revenue grew 50. So here's what kind of justifies. Here's why I still bought the stock despite them losing money still. They have the growth of a beast. I mean, revenue's at a record this quarter. You're right. They also Ouster partnered with Nvidia. We'll see if we can find that in the new. Oh, there is no news tab or AI news tab, but that's all right. So revenue's up 48% year over year. They only lost 17 million. And look at this fortress balance sheet. Basically no net debt. They have 173 mil of cash, so they can afford to lose 17 mil a quarter. And as we expect them to continue to narrow their losses. Yeah, they're only supposed to lose 15 mil in 2 quarters when they lost 21 mil the same time last year, and revenue is going to go to 57 million. So yeah, they do lidar, and what is using lidar? Robo taxis, and they just announced the first ever. Yeah, look at this, introducing world's first native color lidar sensor. So colored lidar, and here's some of their partners. Like they're partnered with Serve Robotics. I see the little green robotics on the sidewalks. They actually use their lidar stuff. Wonder if there's any more here. Oh yeah, Firefly, Google. I think that's like Waymo. Google Waymo actually uses them. I don't know. Oh, Gecko Robotics. There was some good news about Gecko Robotics using Ouster today. I saw that in the news. So someone's collaborate on lidar. There was another news around that. Anyway, Ouster, I wouldn't buy the stock today. They're up 100% in a month and a half. So, and there's no forward PE, but they're only worth 2.2 billion. It's a small cap. Or once they get profitable, I mean, the market cap could just continue to climb higher. That's why I'm not trimming or selling any shares since it's such a small position. I'm not even gonna, even though I'm up 100%, I'm in just a month. I'm not trimming a single share, and again, it's not one you'd kind of want as a meaningful size position, but it just could get you exposure to the tailwind of autonomous vehicles and drone defense. Here I get some news. Integrating native LiDAR sensing, HDR at silicon level for, okay. Let's see if I can find that other news. Yeah, here it was. Gecko Robotics uses their LiDAR sensors. I don't even know. Anyway, let's get off of Ouster. They're a cool company, cool small cap. All right, next up, we got, hey, we actually just looked at Iris Energy. Berkshire Hathaway has 400 billion in cash. So here's what's, y'all want to see Warren Buffett's or the actual Berkshire Hathaway portfolio? Here's what they just did. Does anyone else find this weird? This is the first ever quarter where Warren Buffett made none of the decisions and he stepped down. So Warren Buffett made none of these decisions himself. Here's what's so weird. They sold, here's what they fully sold out of. They have no more shares of these companies. They fully sold out of Amazon, Visa, MasterCard, United Healthcare, they just sold out on Lamar Advertising. And guess what they bought? So they bought two new companies, new additions to the portfolio. What are these Warren Buffett high quality Berkshire Hathaway picks? It's kind of funny. They bought Delta Airlines, an airline, and Macy's. So I don't know about that. I don't know about those new purchases, but one thing I do agree with was their Google increase. Google is now 6.75% of the entire portfolio. They 3x the position. So I can't believe that. So it's now 6.75. Here's their actual portfolio in terms of actual weighting and stakes. So 20% of the portfolio is Apple, American Express, then Coca-Cola, Bank of America, Google, Chevron, a lot of these dividend stocks like Chubb, Moody's, Mitsubishi, Kraft Heinz. That's one of his worst for investments. He has Delta Airlines. That's weird. I like the clear, secure way. Yeah, I know, Luffy. I don't know about Macy's. I mean, let's see Macy's stock. How's their total return done over the past 2 decades? Well, they IPO'd in 1997 at $18 a share. So here they were in 1997. They were on the very left. They were $24 a share. Well, it's the year 2026, May 1st, and they are $20 a share. So for 30 years, they've done nothing, which that's why I don't like mall retail investments. And what about, what was the airline he bought? Was it American Airlines? It was some sort of airline. Let's see how the airlines do historically. Well, here's American Airlines. Um, in 2013, it was $30. Now it's 13, and they just get smoked in a recession, very federally regulated, lots of payouts and lawsuits, and I don't like I'd rather own the airports, like the O'Hare Airport. Oh my goodness, can we find that ticker symbol? Anyone remember that one? Or there's an airport group where they own the actual airports, like all the shopping malls inside, where everything's always super expensive. You know, like the Chick-fil-A. I had it somewhere in the watch list. It wasn't too long ago, and I don't know why I'm still looking for this because nobody cares. But you'd be shocked at how good these. Man, I thought it'd be right around this area in my watch list. Maybe it's been a really long time. Here it is. Here it is. CAAP. So look at this stock price appreciation. What does this company do? This is like an Nvidia type. Here's COVID. COVID, they fell to $1. Now they're $25. What does this company do? Well, they own airports, 52 airports, not the airlines like American Airlines, that's the part. Anyway, let's keep going. Innodata is another one that doubled in the past month. Man, Innodata's been crushing it. They had phenomenal earnings. That's been my growthiest stock in my Roth IRA. Check out my Roth IRA. It's actually this is my big like growthiest position. Innodata's up 100% the past month. Yeah, I'm up 180% now. I've been super impressed. So next up, I saw Iris Energy. Yeah, real quick, it's just had momentum because Nvidia has taken a stake into this company. I would be super, super cautious, and I actually would not buy the stock kind of anywhere near today's prices. But it momentum's because AI, Nvidia is doing good, and Nvidia just took a stake into this company. Yeah. Is there any other news? So yeah, 5-year AI cloud contract with Nvidia. So check this out. What does this company do? They're one of their biggest customers of Nvidia. All this company does is own Nvidia chips. They own a boatload of Nvidia chips. And what are they doing? They're mining Bitcoin with them. That's still 76% of the revenue. The other 23% of the revenue is renting out the GPUs to cloud companies. If we go back just like 2 quarters ago, that AI cloud revenue is only 2.5% of the revenue. So they're switching from Bitcoin mining to AI cloud, but the problem is it's super competitive, very low margin, and actually it's a negative margin endeavor. Iris Energy is supposed to lose money for years to come. They lose heck of free cash flow every quarter, and it's not an Iris Energy exclusive issue. It's all of them. So CoreWeave as well. Is it CRWV? Yeah, here's CoreWeave right here. This is another one Nvidia took a big stake in. I think Nvidia is like propping these companies up. But anyway, we go to like CoreWeave as well. If you look at the net income projections, they're supposed to lose 669 mil, 570 mil the next quarter after. So I'm just not a fan of this part of AI because they're just not profitable. I just don't like owning. Like I can't value these companies. There is no forward PE, and they're light years away from making any sort of net income. I can't value a forward PE. So hopefully I actually like the other parts of AI. Own the companies, in my opinion, instead of just Nvidia, own the whole Nvidia ecosystem. Buy the companies doing the HVAC work, the heating, ventilation, air conditioning, water cooling. Buy the companies doing the complex MEP work, which is mechanical work, electrical work, plumbing work. Like, and buy the companies powering the data centers with nuclear energy, like utilities. I love the utility sector. My specific favorite one that I think is going to be the growthiest of all time is CEG, Constellation Energy. I specifically look for utility. I look for nuclear, and this is the purest nuclear company. They own 33% of all the US's active nuclear reactors. They're just the largest pure play. There is no close second. They have deals with Meta, huge deal with Microsoft. They have this one nuclear plant that just supplies a Microsoft data center, and Microsoft's paying a crazy premium for it because they want nuclear. The market wants nuclear and natural gas turbine, and CEG is the number one natural gas company, or actually, or I think it's RNG, renewable natural gas company, number one nuclear company, and the number one what's it called, geothermal company. They own the geysers. These are super rare in the U.S., but there's certain parts in the U.S., like California, they own the geysers, which supplies literally 10% of all of California's clean energy from this geyser system, where it has hot steam and it powers steam engines. It's all natural from the ground. And then they pump the water back into it, makes more steam, and it's just infinite. It's just literally free energy forever from this geyser place. Super fascinating. They even do tours of it. I did a digital tour. It's a fascinating area. Um, Okay, let's see. Next up, did Buffett not just buy Microsoft? I don't know if he bought Microsoft, and actually, it wasn't Buffett who was. This is the first ever quarter where Berkshire Hathaway um, is not done anything. So these were all their increased size positions. These are the only thing they increased in. These are the only two stocks they added. So they didn't do. He didn't do any Microsoft this quarter. But Microsoft is one of my newest purchases. If I head over here to my Webull account, these are all of my most recent purchases in order. And here's Microsoft. I bought all 3 shares on 327, which wasn't even that long ago. Yeah, there's my buy order right there. But all my shares that day, and I'm shocked because when I bought this, I'm like, this is probably going to go lower, but it just continues to climb higher. Actually, the risk reward is super fair even now on Microsoft, only at a 24 forward PE. They're just the number one software company. 120 billion of their annual revenue is their software, and they're saying Claude Code. ChatGPT could hurt Excel, spreadsheet, all that. But Microsoft, as an owner, 28% owner in OpenAI and ChatGPT, is hedged. So I don't think they're going to get hurt as much as people think. And if AI gets huge, they're the number 2 cloud service provider with Microsoft Azure Cloud. And that'll boom if AI really takes over. Do you know how expense ratio charge on buy? No, it's every single year. So if like VOO right here, or IAU, or I'll just use this as an example. If you buy IAU ETF, they take 0.25% of whatever at the end of the year, 0.25% of your entire position, even if it grows, I believe. So yeah, I think that's how expense ratio fees work. That didn't sound too confident. Pretty sure that's how that works. The only thing does it take 0.25% only of your cost basis, or does it take 0.25% or whatever it's grown to? And I think it might be whatever it's grown to. That'd be something to check. All right. I got out of most stocks, uh, went to treasures 4 to 5%. There'll be a big crash within 6 months. I don't know. I'll be safe. Crypto's going to crash down. That's my take. We shall see. Hey, if the stock market does fall, what you want to do is there's some specific stocks I think are good deals right now that does well if maybe the stock market falls, like a McDonald's. It usually does good in a recession. But yeah, we are on the market seems overbought. But here's the craziest thing. The largest component of the entire stock market, it's 10% of the S&P 500 is Nvidia. Nvidia is worth 5.4 trillion. Here's the thing. A lot of the top companies in the S&P 500, did you know this, are cheap. And I sound crazy, but here's the number. Nvidia trades at a 21 forward PE. Did y'all know that? They only trade at 22 times next year's net income. That's cheaper than the S&P 500. How about another big company like a Microsoft? What is Microsoft's forward PE? Well, Microsoft, another like 5% of the S&P or more, is only at a 22 forward PE. How about Meta? Let's check out Meta stock. Another one. This is kind of why my thesis is you don't really want to sell stocks right now. I think the market's just going to continue to climb higher. That sounds crazy. We might have some short-term pullback, but Meta's at a 19 forward PE. What I'm saying is this isn't the peak. This isn't peak valuations. If this is the peak, I'd be surprised, but Nvidia, these valuations still have room to stretch higher. And so that's kind of my thesis there. And so that's why if you expect the market to fall, don't sell anything, or I would just hold on to the positions and maybe just don't allocate any new money. That's the tough part. It's who's buying the S&P 500 at an all-time high. I know it sounds hard, but maybe buy some individual names like the Microsoft, the Meta, the Nvidia. Individually, maybe you'll get better returns than just the index, but those names are undervalued, I think. All right, let's keep going here. Um, Thoughts on Snowflake? Yeah, hey, what's up, Christian? Sorry if I'm a little behind. I'm missing a lot of stocks here. Anyone looked at Belden BDC? Hey, what's up, Clip? We'll check it out. I like BDCs, or they're a dividend or dividend generators. So here's Snowflake. It's kind of like a Palantir competitor. Let's see. So revenue of 4.6 billion in strategic acquisitions. So net loss of 1.3 billion. Yikes! With accumulated deficit of 9.5 billion. Customer base expanded to 13,000 total customers, including 733 new customers with over 100 mil or with over 1 million in revenue spent a year. So 733 new customers spending $1 million a year, and 790 Forbes Global 2000 customers. Wow, so that's pretty good. So they just completed the acquisition of Observe for 600 mil, Crunchy Data for 200 mil, repurchase shares. Well, anyway, here's the one reason why I think Snowflake is struggled so hard. It's a net income problem. So if we just go to net income losses, they still lose a very unsustainable amount of money to really trust. They're losing, 300 mil a quarter or more. And let's actually see if so. Actually, good news, it is supposed to narrow. So they're only going to lose 280 next quarter and 250 next quarter. So this is great. We definitely want to see them continue to narrow the losses. And the revenue is going to grow potentially from the billion of acquisitions that they just did. But anyway, the net income losses is the one scary part about the company. So it's kind of hard to value this one. A $57 billion company losing a lot of net income and not going to make any net income anytime soon. Uh, so it's kind of stuck in its valuation. So I saw someone clip said Belden. Hopefully I can find them. What's the ticker symbol? It's just ticker symbol BDC. That's funny. So yeah, BDC again, this is a business development company, and BDCs by law have to pay out 90% of their taxable income in the form of a dividend. So they actually have a very low dividend and payout ratio. So this actually is not a BDC, but the ticker symbol is BDC. So I got confused. So forget everything I just said the past 10 seconds. This company does not pay out a lot of its earnings in the form of a dividend. Or it's not required to. So this does not do first lien and second lien loans. This is not a loan company. I just got confused because of the ticker symbol BDC. But anyway, automation revenue, that's what this company does. Automation's up 10%, broadband is up 6, smart buildings is up 20%. Let's actually check out their website right here. Communication equipment is their actual sector. So the guy says, and partnered with OptiCool for AI data center cooling. Acquiring Ruckus Networks, isn't that from Viasat Networks? Let me check out VISN after this. But anyway, here's their website right here. So automotive manufacturing. So they maybe build the robots at Tesla factories that assemble the cars. If you know what I'm talking about. I guess they serve a lot of sectors. Wow, look at that, 120 years. Well, anyway, that's their website right there. Pretty interesting. What's the forward multiple in net income? So they are very net income positive. They're making 60, 50 million in net income a quarter. How about the revenue? The revenue's up 11, but the profits are up 7. So actually margins are holding up fine. It was a slight decline in margin, fell 5.8%. Maybe maybe that's why the stock fell. Maybe they had some tariff related stuff that hit the margin. But anyway, interesting company there. I wish I could give you more thoughts on them. But yeah, 17 forward PE seems pretty fair. VISN, no way. So did they change their VISN? So Viasat Networks, that's what's so crazy. They sold off their best cable fiber optic business to Amphenol. So for $11 billion. So they rose $11 billion of cash. Because look, before today, this was their balance sheet. It was you couldn't buy the stock. But now with this Amphenol deal, they have zero debt, a lot of cash. So they sold off this cable business to Amphenol, and Amphenol got a good deal on it because they can pay off their debt much faster, and it's accretive to their EPS and their synergies. So actually, I'm a fan of APH stock, and this one's only at, if you look at the top here, a 23 forward PE. Really cool company. So, yeah, is this Mumu? Yeah, Jerry, this is Mumu. Actually, this is a brokerage right here called Mumu. If you'd like to get this app with my affiliate link, I actually have it linked in my profile or my bio there. If you sign up and like deposit $100, we'll both get like a free stock actually. Actually, speaking of Amphenol right here, I want to go to their investor relations, kind of show you what markets they serve. Mainly the real growth. Oh, I don't think they have an investor presentation. So anyway, we'll get off Amphenol. Anyway, APH is my favorite, like interconnect business. All right, we'll look at a few more here. Intuit, yeah, they reported earnings yesterday. Let's see what happened. Dang, they are down 20% on the day. 17% of workforce is being cut. Look at that. A 15% dividend increase, though. Intuit lowers their TurboTax annual revenue guidance, citing approximately 2 million IRS filers. Well, anyway, this is like your tax. I'll send that to someone later. DIY customers earning under 500,000. Oh, citing a decline of 2 million filers among DIY, price sensitive DIY customers earning under $50,000. I mean, I just read that whole thing wrong. I should have read that in order. So, contraction of 30 basis points in margin. So, anyway, 2 million less DIY people doing TurboTax. But here's good news. And that's 8 billion share buyback program. They cut 17% of workforce. They're partnering with OpenAI and Anthropic to integrate models into their software. So anyway, yeah, this is your tax company. The valuation is now dog cheap. Maybe people can file their taxes through AI now. You don't need this, or I don't know. But yeah, I don't think that that's going to happen. I don't think you probably want to trust AI yet with taxes. You just trust into it. But yeah, they own QuickBooks and stuff. They have a 16 forward PE and they print net income every quarter. Like they really do only trade at 16 times net income. Why does this is tax season every year, Q3 or fiscal Q3 or whatever. That's their huge tax revenue quarter. So yeah, this is their net income over time. And if you look back in the day, like they'd make a bunch of money that one quarter, and then the other quarters they'd make no money. But now check out the other quarters. All the other quarters are evened out, also making a couple hundred million every quarter. So they actually did 3 billion net income. They beat on net income. They beat on revenue just slightly. But I'm guessing it's this bad guidance of TurboTax 2 million decline, something like that. Hey, what's up, Matt? Good to see you. How's Meta doing after the layoffs? Yeah, Meta. What's their Meta layoff right here? Um, I thought it was like a restructure. Oh, yeah. Implements major restructuring, 8,000 layoffs, 7,000 employees reassigned to AI roles, and raises their capex to 145 billion. So that's the one thing being questioned on Meta is how much they're spending on AI. But that wouldn't scare me at a Meta. They're spending more than they're making. 34 billion. This is their capex at the bottom. Their cash from investing activities. You want this to be negative. If this was positive, that means they're actively selling out of their own assets for a profit. So which you don't want to see, or selling out of their business for cash. You want it to be negative. But yeah, if we go to their net income, basically they make 22 to 24 billion. So they're spending a lot more than they're making. So they have a net debt position for the first time ever. But again, that doesn't scare me at a Meta. They're a money printer with other ad businesses. So yeah. I love what they're doing with their Meta Ray-Ban glasses. Iris, please. Hey, Clem, we looked at Iris Energy just like a couple minutes ago. I saw your first chat of Iris Energy. So actually, if you rewind like a 10 minutes or something, I think you'll find it. It wasn't too long ago. I'm actually about to end the stream in a minute here. Hey, what's up, Vinny? What's up, everyone? CTSH. I'm going to look at Apple. See Apple and American Tower Corp. So this is Cognizant. Maybe it's a software company. They're on a massive decline right now. Let's see if we can figure out why. You get a 2.5% dividend yield, so that's great news. So they do financial services, health services, product and resources, and communications media. They are very diversified. So they have like 4 main businesses. When we combine all 4 of them, so the revenue grows single digits, 5 or mid single digits, 5, 4, 7, 8, 7. So yeah, so really low single digit growth. Kind of the revenue is almost the same as it was in 2022. But they still do make a lot of net income. They're making 500 mil in net income a quarter. So I don't know about this one. North America has most of the revenue. 9 forward PE. Does Morningstar have any coverage? Morningstar does not cover them. Is this like a broadband company? Um I don't know. They're in a lot of different sectors. So Anyway, interesting there. We just kind of want to see the growth come back, I think. Yeah, dang, the stock's the same price that it was in 2014. 2.5% dividend, safe payout ratio. AIPO, this is a really cool company. If you own Apple devices, why not own the stock as well? I'm always a fan of companies you actually use and like, why not own their stock as well? But you got to make sure they have good quality fundamentals, and Apple does. Only bad part is they're slightly expensive, but not crazy expensive. Even though Apple's at an all time high, they're at a 33 forward PE. So selling hardware iPhones is half the revenue. So that does, 200 billion in revenue a year, but their highest margin business is actually their services. So whenever you go buy something in the App Store, like you spend money on Clash of Clans or something, they keep a 30% fee. They literally, it's like as a developer fee royalty. So they collect super high margin royalty fees from their App Store. So that business right there, just the services, that also does over 110 billion of annual revenue for them. I think that also includes iCloud. Then they have Mac, wearables, but they're also an international company. US is only 36% of revenue, Europe's 26, China's 15. So great companies, but check this out. They are actually the world's number one buyback program company. No other company in the world does more buybacks than Apple. They made look at the past 2 quarters, 30 billion of after-tax net income, 42 bill of after-tax net income last quarter, and that's real. Before tax was 50 and 35. After was 42 and 30. So last quarter they made 42 bill of after-tax net income. What are they doing with all that? Well, here's why they're going to be a great dividend growth stock. They pay a dividend, it's in the cash flow statement. The dividend only costs 3.82 billion. If you notice, how did the cost of the dividend go down? It went from 3.95 to 3.82. Did Apple cut their dividend? No, it's actually because they're the world's number one share buyback company. They spend on average close to 100 billion of net income a year solely buying back. Oh my goodness. Okay, sorry. Okay, that was loud. What the heck? Sorry if the stream cut out. They made me fill out a captcha. But anyway, look at this. They spend like 20 billion of after-tax net income a quarter solely buying back their own stock. And when you buy back your own stock, that makes the dividend cost less and it makes the EPS grow faster. So net income was up by 19, but the net income per share grew by 21.8. It's because the share part of the ratio went down. That's the power of the buybacks. Makes the dividend cost less, makes the EPS go up, gives you more ownership in the company, and in short, basically makes the stock go up, forces it up. I love share buyback companies. That's why I specifically buy companies that like I look for companies that do a ton of share buybacks. So yeah. Let's see. We'll look at one or two more here. Oh, what's up, Marcos? He said waste management. This is a great dividend stock. It's like AI proof. People always are throwing away trash, and they've had monster stock price appreciation. So historically, you get like 7, 8% of your money back a year, on top of getting 1.6% of your money back in a qualified dividend every year. So this is actually, I think, kept up or maybe even outperform the S&P 500, and even at all-time highs. This is why I think they're going to stretch up a little higher. They're only at a 26 forward PE. I think that could still stretch up a little faster. So Morningstar actually says they're overvalued. Cyclical volume headwinds, recycled commodity price volatility, and heightened integration risk from recent Stericycle acquisition. Oh yeah, it's a huge medical disposal business they bought back here for basically $8 billion. So they own some medical disposal business, which is now they said going to be accretive to EPS. But anyway, they just print 700 million net income a quarter. You get a dividend, and I just trust them. That's like a stock you trust, maybe even more than like some AI stocks. Like you trust the long term horizon, the long term view on waste management more than maybe like Nvidia or you know what I mean, like in terms of 10, 20 years from now. How are defense companies doing? Yeah, let's check out Raytheon. So actually, a lot of the defense stocks are on a downtrend. Raytheon's off its all-time highs. Palantir's off its all-time highs. Lockheed Martin. These charts look pretty similar. Yeah, here's Lockheed Martin, Palantir. So if you want to know my favorite defense stock to buy, I actually just loaded the boat on them, and I'm proud of them because they haven't fallen as much. This, in my opinion, is the best aerospace and defense stock, like, or actually, well, I don't know about the best, but it's my favorite one. 10 billion market cap, $13 billion backlog, 1,300 plus patents. Every single mission in space history, major satellite and rocket mission uses their patents. They own over 1,300 of them. And like the Voyager spacecraft uses the one in space still uses their patents and valves and stuff. But yeah, they help out space and defense industry. That's their main industrial, which is actually data center cooling pumps. They have this seamless, like this sealless data center cooling pump that they have a patent on that their competitors don't. So this actually growth has been fueled by data center cooling pumps. And then they also do commercial aircraft repair with their components and stuff, and military aircraft. So another huge defense contractor. They actually have the patent for the heat or the heat seeking missile, like the actual one. All of it goes through this company right here. The thing that makes the missile like turn in the air, they own that. It's kind of crazy. All right. So they have huge partners with Raytheon. So Raytheon's missiles use Moog's patents, and same with Lockheed Martin. They and their space, like the space. Oh no, the front of the airplane where like the two little steering wheels are. A lot of those, the inside of these are patented as well by them. They're really cool. I actually did a whole. I don't do many of these, but I made a YouTube video recently. Well, probably a year ago. I made it on my homepage of my YouTube channel. I've done one for Powell Industries, Comfort Systems, and now I've done one for Moog. I said I would go all in this one stock. I made a whole video dedicated to Moog about a month ago. So if you go to my YouTube channel, you can actually find my analysis on Moog stock right here, MOG.A. So here's my buy order. I bought them after their massive rally. I didn't even mind with their 13 bill backlog. 29 forward PE, 10 bill market cap, margin expansion. You won't believe this. So check this out. The revenue grew 12% year over year on Moog. So revenue's up 12. Net income is up by 49 million. Oh yeah, and they said they're going to get 50 million of new revenue from data center cooling pumps this year, just to data centers. So anyway, watch out for those people in chat there. Hold on here. All right. So next up, I gotta go soon. So Vinny said NUVB. Let's check this one out. Nuviation Bio. I actually have them on my watch list. Let me see why I did that. Maybe something impressed me. So there is no forward PE. So that's scary. They're worth 1.6 billion. Do they have revenue? So they do have revenue. So that's impressive. Okay, wow, look at that. They did. This is why I put them on my watch list. Actually, I am impressed again. So I thought this one was bad, but actually I'm impressed. So check this out. They did 83 mil of revenue, and you know how they don't have a PE or forward PE? Because they always lose 36, 45 mil. They actually made net income this quarter, and that's real. Like operating profit and net income were both positive. The business really made a profit this quarter. Do analysts cover this one? So analysts do project them to lose 50 mil next quarter and 40 mil next quarter. But notice, analysts projected them to lose 17 million this quarter, but they made 5 million. And same with EBITDA. The basic metric. No, there was no one-time adjustment making this. It says expected to lose 26 mil of earnings before interest, taxes, EBIT. They actually made 4 mil. Imagine next quarter if they beat like crazy as well and not lose 51 mil. I think that could make a massive rally, but it's still one you want to be very careful with. I don't even know what they do. I'm just analyzing the financials here, and I'm just impressed with what I see. Because a year ago, you couldn't buy the stock. There was no revenue, but maybe you could buy this one as something special is about to happen. They did 83 mil of revenue this quarter, made a profit on it. Interesting. All right. Not one I trust with a lot of money, though. I'd be real careful. Eaton and APH best infrastructure plays? Absolutely. Amphenol is super good. Eaton's a little expensive. Well, those are probably like the best infrastructure plays to buy now. There's also some probably arguably even like better companies than Amphenol. And then, like, here's some other great ones like Bell Fuse is really good. Siemens Energy, Hubble, PWR Quanta. This stock has been a monster. I love their products as well. Corning. I also have an HVAC watch list. Vertiv, or actually, I believe they're pronounced Vertu. Comfort Systems. Like, these have been another interesting sector. So I'm a big fan of electrification stocks. Buy the electrical infrastructure, buy the HVAC companies, the companies doing the MEP work, mechanical work, electrical, plumbing for data centers. I love these. So next up, I saw PE too high for growth. Hey, what's up? What do you think about Futu dropping? Yeah, so anyway, all the brokerages, we actually analyzed them a couple, or just like 10, 20 minutes ago, so I won't go over them again. But yeah, Futu, I think it's following the general downtrend of all fintech and brokerages. So here's SoFi right here. SoFi is like 50% off its $32 peak just 6 months ago. How about like Robinhood as well? Like Robinhood's no exception. It was 150 and now it's 76. So it's just kind of following weakness in the fintech market, but that's the most high quality one to buy in my opinion. FUTU. Apple user said NU. This is another fintech stock on a dip that not financial advice I'd look into getting, but this one is specifically if you like Brazil markets and crypto. It's they're actually a crypto bank out of Brazil. And if we look, where does this company's revenue come from? They're headquartered in the US. They don't have a US banking charter. They're applying for a US banking charter, but they are huge in Brazil, and that's where crypto for transactional purposes are really popular. But here's the bottom line, and this is after tax net income in U.S. dollars, not Brazil, and they're headquartered in U.S. So, but they make legit 800, 900 million net income a quarter. And check out the projections. It's supposed to hit a billion next quarter, a billion the quarter after. They just fell on earnings because they slightly missed on net income. They expected 927. Well, they did 870 million net income, which still grew 56% year over year. If we zoom out, like in a year from now, no one is going to question this. Like this is just business as normal. That's still phenomenal growth. And the valuation is now very fair. And a forward PE, they only trade at 14.9 forward PE, a 20 PE. Part of the reason they're so cheap is because they're basically Brazil. All the revenue comes from Brazil, so that just demands a lower multiple than a U.S. company. But still really interesting. Evertiv, then do Modine and Invent2. Hey Vinny, can you actually give me the ticker symbol for that stock and we could check it out? CBRA, yeah. Hey, was that the Cerebras IPO? Wait, CBRA or CBRS? Oh, yeah. Okay, there it was. Cerebras Systems. I would be careful. Basically, is there any financials for me to analyze? Revenue was okay. Well, that's some impressive growth. Do we get quarterly data? No, but we get cumulative data. Are they a U.S. company? They gotta be. Yeah. Okay. Well, check this out. I mean, revenue growth is impressive. So as we can see, revenue was for the full year 2025, it was 509 mil. But I'm assuming yeah, so they actually lost 150 million for that full year, 100 million the year before. So they are losing like 20, 30 million net income a quarter, which is tough because look at this balance sheet. And this will probably fix whenever they IPO because they just got a bunch of funds. And again, there's not much data for me to analyze here, but I would stay away from this one for now. I wouldn't buy this stock. Looks like actually most of their revenue is outside the US. US is only 36% of revenue. Europe, Middle East, and Africa, just those three countries are 63% of all the revenue for full year 2025. Anyway, I think it's some sort of new semiconductor company, but not making any net income or hasn't made any net income yet. Maybe that's why they're raising funds. Modine. Oh, Modine Manufacturing. Oh, Mod. I feel like I've heard of this one right here. Yeah, they've done phenomenal, just like Comfort Systems. What do they do? Also like MEP work or Climate Solutions, HVAC work. Yeah, I love HVAC companies. You know what? Oh, Carrier Global is another one. I actually saw a Carrier Global truck yesterday. I'll add that one to the HVAC watch list. Thanks for that. So Modine, I didn't realize. So we'll add that to the HVAC watch list. 60% of the revenue is HVAC. And check out that growth year over year. Highest growth rate on the whole screen. It grew 51% year over year. That's impressive revenue growth. And the net income projections are good. Looks like they must have had a slight one-time adjustment. Says they lost 57 mil in net income. EBITDA, though, earnings before interest taxes was 90 mil. So I'm assuming there was a one-time gap adjustment to their net income because it was actually operating profit grew 43, revenue grew 30. So margins expanded. Most profitable quarter they've ever had in history for Q3. So, but it says they lost 47 million net income, some one-time adjustment. But look at the net income forecast. It's supposed to hit 87 million in 2 quarters. If we zoom out on the net income, it's never even been close to 87 million before. So they're about to hit record net income, and that's what's being priced in. But yeah, 37 forward PE, that's fair. 37 forward PE, again, says 140 trillion 12 months. That's affected by the one-time EPS adjustment. It says it was negative. It wasn't actually, but 37 forward PE might be a little too expensive to buy at today's prices. What's Comfort Systems forward PE? Comfort Systems is at a 42. It's honestly undervalued. So anyway, I do have to go. Real quick. Oh yeah, Walmart right here. What's up, Mr. Gurdon? Yeah, Walmart reported earnings today. They fell 7%. And let's see what was the bad news. Issues. So they issued Q2 EPS guidance below consensus, and this is on fuel cost pressures. It makes sense. Average gas purchases fell 10 gallons per visit for the first time since 2022, signaling consumer stress, particularly among lower income shoppers. Nice. So that's what the CFO was warning of. So that's probably why the stock fell 7%. And any sign of slowdown when you have a high PE, you'll fall. So look at this. If we look at Walmart's valuation, before today, they were at like a 50 PE. Well, now they're at a 41 forward PE, which is still too expensive for me to personally buy. So that's why I'm still not going to buy the dip on Walmart, but they're very high quality, one of the most high quality real estate portfolios in the world. I like Amazon a little more, but yeah, e-commerce sales actually grew 26% year over year. So the e-commerce thing's doing good. Walmart cuts 1,000 corporate technology jobs. Reaffirms full-year guidance below estimates. Walmart absorbs $175 million in Q1 fuel cost. Warns of higher retail price inflation ahead. So that's probably what's sending the stock down. So anyway, let me end this with a portfolio update. Bro, please make a YouTube channel and post lives on there. Hey, Trade, thank you very much for saying that. Actually, that's the best way to support me. If you want to help me out, please subscribe to my YouTube channel. I actually do have a YouTube channel. It's called Nathan Robert. If you just look up on YouTube, Nathan Robert, you'll find it. And I'm actually streaming on there. So if you missed anything, you can rewind it. Oh, hey, Wade said, what app are you using? Yeah, hey, I'm actually on a brokerage right here. It's a software where you buy and sell stocks on. I actually have it linked in my bio. It's an affiliate link too. You can just type it into Google or your app store. It's a brokerage called Mumu. But if you use my affiliate link and you deposit $100, we like both get a free stock or a couple free shares or something, which is pretty cool. Like when I signed up, I got a free share of Ford. I just instantly stole it because I'm not a fan of holding Ford in the long run, but I got a bunch of free shares here. When was that? I'll show you the day I started Mumu because that's when I sold this, or I got it shortly after. So when you get your free stocks, you can just sell it. Dude, why is Ford glitching out? There we go. Okay, here's Ford right here. I sold it on August 8th, 2023. So that's when I started my Mumu account. And anyway, that was the stream. Hope you guys have a great rest of your day. Dang, I just joined. Dang, Kyle, I feel bad. Graham, I don't even know what Graham is. So if you had a stock, you'd have to give me the ticker symbol. But anyway, I do apologize. If you want to help me out, please subscribe to my YouTube channel. Again, it's called Nathan Robert. And just hit the follow button on TikTok. I'm going to be streaming like every day, every other day. Now that it's summer, I don't have any college classes. Again, none of this is financial advice. I sell absolutely nothing. I have no course, book, WhatsApp. I don't mentor. No course, nothing like that. I'm just on here analyzing stocks. But if you want to help me out, hit the follow and subscribe button to the YouTube channel. Have a great rest of your day. But I do have an affiliate link if you'd like this brokerage I'm on. I have an affiliate link linked in bio where if you sign up, we both get like a free stock, which is pretty cool. Anyway, see you. I hope you have a great rest of your day. See you soon. And thanks again to everyone on the YouTube stream. Wilty, Clem, Clip, the members, Looney, FNS, Sora, Yusuf. Thank you guys very much. I was a little tired today, so I apologize.